Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, let's dive in. Today we're going to try and decode one of the most powerful and honestly most misunderstood forces in the financial world, the market cycle. We're going to be leaning heavily on the incredible wisdom of Howard Marks' book to really get a handle on the patterns that drive markets. But more importantly, we'll talk about how you can actually use that knowledge. Let's get to it.
I love this quote from John Kenneth Galbraith. It cuts right to the heart of the problem every single investor faces. We're all desperate to know what's around the corner. But the hard truth, predicting the future is pretty much a fool's errand. And what Galbraith is saying here is that most people who try are in one of two camps. Either they know they can't do it, or, and this is the dangerous group, they have no clue they can't. This is our starting point.
And that quote perfectly sets up our first section, the investor's dilemma. I mean, if we accept that we can't really trust forecasts, then how on earth are we supposed to navigate a world that feels so completely unpredictable?
You know, what's so great about this slide is how simple it looks. But the idea behind it is, well, it's massive. Howard Marks makes this point that our brains, they're just hardwired to look for a clear cause for every single effect. We need patterns, we need explanations. But the reality, especially in the market, is that a huge chunk of what happens is just random. It's just chance. Accepting that randomness is honestly the first big leap you have to take to start thinking like a truly superior investor.
So why is it so tough? Let's just break it down a bit. Imagine trying to predict if a movie is going to be a hit. The reasons it might succeed or fail are just unbelievably complex. Or think of a baseball player stepping up to the plate. Sure, his skill matters, but so does his health that day, the wind, the glare from the stadium lights, maybe even what he ate for lunch. I mean, there are countless random things you could never see coming. Now multiply that complexity by 1 billion and you get the market, which is all driven by us, by human behavior. And let's be honest, we are anything but consistent.
Which, of course, brings us to the million-dollar question, right? This is what this whole explainer is really about. If the future's a mystery and forecasting is basically useless, what are we supposed to do? Just give up? Is it all just a big casino? No, absolutely not. There is a much, much better way to approach this.
And that better way is this secret we're going to dig into in our second section here, understanding market cycles. This is the heart of Howard Marks' whole philosophy. The key isn't trying to predict the future, it's about understanding the present. And you do that by figuring out where we are in the cycle.
This little drawing, this explains almost everything. It's brilliant. Mark says he draws this simple diagram in practically every meeting he has. Okay, so that straight line, that's the long-term trend. Think of it as the economy just slowly, steadily growing over many decades. But that wavy line, that's the cycle. That's the series of ups and downs that happen around that main trend. And that is where all the action is. That's where all the opportunity and all the risk really lives.
So let's make that wave a little more real. A cycle isn't just up or down. It has these different phases. It starts with a recovery from a low point. Then it swings past that middle average point on its way to a high. It peaks, and then, naturally, it corrects back down. It overshoots again to a new low, and then the whole process just starts all over again. Knowing these phases is how we figure out where we are on that wild ride.
Now, this is a really crucial idea. Symmetry. It's not just that busts happen to follow booms. No, the boom causes the bust. All the crazy excess, the wild optimism, the risky behavior that you see at the top of the cycle, those are the very seeds of the crash that follows. And on the flip side, the doom and gloom and fear at the bottom, that's what creates the perfect conditions for the next big recovery. One side literally creates the other.
So you have to ask, what's driving this whole thing? What's the engine that powers these massive swings? Well, as we're going to see in Section 3, it's not complex economic models, it's not spreadsheets, it's us. It's plain old human psychology.
Marx uses another fantastic visual here, the pendulum. Just picture it. The market's mood is always swinging between two extremes. On one side, you have greed, you have optimism, you have total euphoria. And on the other, you've got fear, pessimism, and depression. And here's the key. That pendulum almost never, ever just rests in that calm, rational middle. It's pretty much always moving, heading towards one of those emotional extremes.
And hey, if you're sitting there thinking, oh, I'm too smart to get swept up in all that, let me tell you a little story about Sir Isaac Newton. Yeah, one of the greatest scientific minds in all of human history. He invested in something called the South Sea Company, realized it was a bubble, and got out early with a tidy profit. Smart, right? But then, he had to sit there and watch his friends get richer and richer as the mania kept going.
He couldn't take it. FOMO got him. He jumped back in near the very top and lost a fortune. Even Newton couldn't fight the psychological pull of a bubble.
So why do these things keep happening over and over again? Galbraith just nails it here. We forget. As a group, our memory of financial pain is unbelievably short. The lessons from one disaster are just, poof, gone in a few years. And that allows a whole new generation of really confident investors to come along and make the exact same mistakes, just maybe dressed up in a new outfit.
And this brings us right to section 4, where we've got to really hammer this point home, the myth of prediction. With all this emotion and randomness sloshing around, trying to pinpoint the exact top or the exact bottom of a market is just a losing game.
Marx tells this classic story of the blind men and the elephant to explain why this is so hard. You know the one. Each man touches just one part of the animal, a leg, the trunk, the tail, and they all come to these wildly different conclusions about what this thing is. Well, in the market, in real time, that's us. We're all those blind men. We can only ever see a tiny piece of the whole picture, which makes forecasting where the whole elephant is going to move next pretty much impossible.
So, if Marx isn't trying to predict the future, what is he looking at? This is so important. He says he worries less about the unknowable future and more about the knowable present. Specifically, what's the supply and demand for capital look like right now? Is money easy to come by or is it tight? Are people scrambling to invest or are they terrified? These are things you can actually see and feel.
Okay, so if we can't predict, what can we do? This brings us to our fifth and I think most important section, the art of positioning. This is where it gets actionable. This isn't about prediction, it's all about preparation.
Here's the difference in a nutshell. Prediction is basically a low probability bet. You're trying to be exactly right about the future. Positioning, on the other hand, is a much higher probability strategy. You're just assessing the environment today and then adjusting your portfolio for what's likely to happen from here. Are things looking risky? You get more defensive. Does it look like there's tons of opportunity? You get more aggressive. It's that simple.
And what's so great about this slide is how practical it is. Marx basically gives us a checklist to take the market's temperature. You know, when things are at a risky high point, the economy seems amazing, lenders are throwing money at people, and the news is all sunshine and roses. But when there's amazing opportunity at a low point, the economy is in the tank, lenders are hiding under their desks, and every news story is about the end of the world. See? This isn't about complex math. It's about observing the mood.
And these two images show you exactly what we're talking about. Defensive positioning on the left, that means you're okay with maybe making a little less when times are good in exchange for losing a lot less when things go bad. You're playing defense. Aggressive positioning on the right is the opposite. You're taking on more risk because you want to capture more of that upside when the conditions are right. A great investor just knows when it's time to shift from one to the other.
So the whole point is this. Your strategy has to be the opposite of the cycle. It has to be counter-cyclical. When the cycle is at its absolute bottom, when everyone is terrified and selling everything that's not nailed down, that's when you need to have cash ready and the guts to actually buy. And when the cycle is at its peak, when everyone's euphoric and throwing parties, that's when you need to be cautious and have the discipline to not get sucked into the madness. The things you need to succeed are the exact opposite of what the crowd is feeling.
So after all of that, what's the big takeaway? In our last section, let's just boil all this down to the key ideas you really need to hang on to.
Okay, here it is. First, cycles are always going to be with us, simply because greed and fear are baked into our DNA. Second, your job isn't to be a fortune teller, it's to be a really good detective, trying to figure out where we are today. Third, the way you get better results is by positioning your portfolio based on the probabilities of where we are now. And finally, the mantra that says it all. You can't predict, you can prepare.
And that's where we'll leave it. Howard Marks has given us this incredibly powerful way to think about the markets. That pendulum of emotion and risk, it's always moving. So the only question that really matters is, right now, are you paying attention? Do you know where you stand?
Today we're going to talk about something that I think is absolutely fundamental to being a smarter, more successful investor. And look, it's not about having a crystal ball or predicting the future. It's about something much more powerful, understanding the present so well that you can actually start to tilt the odds in your favor.
This question. This is the one, isn't it? It's the million-dollar question everyone wants the answer to. We're all desperate to know what the economy or the market is going to do tomorrow or next month or a year from now. But what if I told you that's exactly the wrong question to be asking?
You know, Warren Buffett gave us this just brilliant filter for cutting through all the noise.
He said that for any piece of information to be useful, it has to be two things. It's got to be important and it has to be knowable. And here's the kicker. While the future of the macroeconomy is definitely important, for almost all of us, it's just not knowable. Not with any consistency anyway. And if you can't know it any better than the next guy, you can't use it to get better results.
So here's what we're going to do in this explainer. First, we'll talk about why trying to forecast the future is, well, pretty much a futile effort. Then we're going to shift and talk about where we should be putting our energy. We're going to introduce a whole new way of thinking, in probabilities, not predictions. Then we'll see how market cycles can dramatically, and I mean dramatically, shift those probabilities. And finally, we'll see how you can use all this to become a truly superior investor.
All right, so let's dig in. Why is it that so few investors, even the pros, consistently beat the market by making these big, bold macro calls? Well, the simple truth is it's almost impossible to know more about the big picture future than the combined wisdom of everyone else out there.
I mean, just think about it for a second. If you're looking at the same data as everyone else, and you're analyzing it in the same way, and you're drawing the same conclusions, how can you possibly expect to get a different result? It's just not going to happen. Superior performance has to come from having some kind of edge, a superior insight. And when it comes to the macro future, that kind of unique, actionable edge is just incredibly, incredibly rare.
Okay, so if trying to predict the big picture is a dead end, where do we go? What do we do? Well, it's simple. We focus on what is knowable. We stop trying to be fortune tellers, and instead, we become masters of the present reality.
And really, there are three main areas where you and I can gain a genuine edge. First, knowing the fundamentals of a specific company or an industry better than the market does. That's hard work, but it's doable. Second, being unbelievably disciplined about the price you're willing to pay. And third, and this is what we're really focusing on today, is deeply understanding the investment environment you're operating in. And you do that by studying cycles.
And this is such a critical point. Understanding where we are in a cycle isn't about making one big, risky bet on what's going to happen next. No, it's about calibrating your entire portfolio. It's about knowing when it's time to play offense, to be more aggressive because things are cheap, and when it's time to play defense because assets are expensive and the risks are piling up.
Now this brings us to what is a huge mental shift for a lot of people. We have to completely move away from this world of trying to make predictions, of seeking certainty, and instead we have to embrace the world of probabilities and tendencies. This right here is where the real power lies. Look, we can't know for sure what will happen. It's impossible, but we can have a really good sense of the range of things that could happen and which of those outcomes are more or less likely. These are what we call tendencies. The future isn't one single point on a map, it's a whole spectrum of possibilities. And here's how that changes your whole approach. A forecaster, they're trying to pick the one single outcome they think is destined to happen. It's an all-or-nothing bet. A superior investor, on the other hand, sees the whole range of possibilities. They don't bet on just one thing. They position themselves to benefit from the most probable set of future events. It's a totally different game.
So let's make this really concrete with a simple analogy. Imagine there's a big jar, and it's filled with 100 black and white balls. Your job is to bet on which color is going to be pulled out next. Now, if you know nothing about the mix of balls in that jar, it's a pure 50-50 guess, right? But what if you had an edge?
Let's say you have some special insight. You know for a fact that the jar holds 70 black balls and only 30 white ones. Now, you have a probabilistic edge. So let's look at the math here. If you bet $10 on black every single time, over 10 tries, you'd expect to win 7 of those times for a $70 gain. And you'd expect to lose 3 times for a $30 loss. Your net expected profit is $40. You see? You've tilted the odds of the game in your favor.
And this right here is the main takeaway from that little game. Even with that huge 70-30 advantage, you still don't know for sure what color the very next ball is going to be. It could easily be white. But you know enough about the underlying odds to play the game profitably over the long haul. That is the essence, the absolute core of being a superior investor.
So the big question is, how do we find the 70-30 edge in the real world of investing? Well, the answer is by understanding cycles. Because the movement of the economy and the market through their natural cycles, it literally changes the odds of what's likely to happen with your money.
So let's start with a baseline, a kind of normal state of affairs. In a neutral, middle-of-the-road environment, the possibilities for making or losing money are pretty well balanced. There's no particular edge one way or the other. It's basically a coin flip. And this chart here shows that perfectly.
It's a normal distribution of returns. That peak in the middle, that's the most likely average return. And you have a pretty symmetrical chance of landing somewhere to the right, which is gains, or to the left, which is losses. So just let that sink in. This is our starting point. This is our 50-50 baseline.
But here's the thing. Things don't stay normal forever. When the cyclical forces, things like a recovering economy, sober investor psychology, and reasonable prices, when all those things line up in your favor, the entire probability landscape changes. The whole game shifts.
Now look at this. This is what's so fascinating. The whole curve has literally moved to the right. So what does that mean? It means the average expected return is now higher, the probability of you getting some really significant gains has gone up, and, this is critical, the probability of losing money has shrunk. The game is now tilted in your favor. The odds are on your side.
But, of course, the reverse is also true. When cycles reach those dangerous extremes, you know what I'm talking about, euphoria, everybody's taking crazy risks, valuations are through the roof, well, that's when the odds turn decidedly against you.
And this slide illustrates that danger zone just perfectly. The entire curve has shifted way over to the left. The chance of achieving even a small gain is lower, and the probability of a permanent, painful loss of your capital is now much, much higher. This is the time when being defensive is absolutely essential. The odds are now actively working against you.
Okay, so how do we wrap all this up and put it to work? It all comes down to cultivating a different mindset. A mindset that is constantly, and I mean constantly, aware of these cycles and how they are shifting the odds for or against you.
I mean, here's the bottom line. The average investor, they get caught up in the news of the day. They see all these isolated events. They're totally passive, just letting these powerful cycles happen to them. But the superior investor, they see the patterns. They understand where we likely are in the bigger story, and they actively position their portfolio and take advantage of the prevailing odds.
And this means you're constantly asking yourself these kinds of questions. This isn't forecasting, it's just observation. Are investors euphoric right now, or are they terrified? Are assets being priced for absolute perfection or for total disaster? The answers to these questions are what tell you whether the odds have shifted in your favor or against you. And that, in turn, tells you whether it's time to lean in and be aggressive or pull back and be defensive.
And that really leaves us with the final and most important question, the one you have to ask yourself. Take a really hard look at how you're invested right now. Is your mix of risk and safety based on a cold, hard assessment of where we are in the cycle and the probabilities that implies? Or is it based on wishful thinking, on just a hope that the future will unfold in the one specific way that you want it to? The answer to that question makes all the difference in the world.
Have you ever just looked around and wondered why everything seems to move in waves? You know, the economy, the stock market, heck, even our own moods. Well, that's what we're digging into today. That fundamental pattern, the cycle. And let me tell you, once you really get it, it's like having a superpower.
I mean, it's a question we've all asked ourselves, right? Why does that incredible feeling of growth and optimism always seem to crater into a painful decline? It can feel chaotic, totally random. But what if it's not random at all? What if there's this powerful, almost predictable force at work behind the scenes? That's exactly what we're going to uncover.
Okay, so first things first. We're going to move beyond just, noticing that things go up and then they go down. We are going to lift the hood and see what's actually driving these massive, powerful swings. And you know what? It all starts with a drawing this simple. Now, it might not look like much at first glance, but trust me, this diagram is an unbelievably powerful tool. It perfectly captures the two core elements you'll find in pretty much any cycle you can think of.
So, that straight line you see, the one moving from the lower left up to the upper right, we call that the secular trend. You can kind of think of it as the baseline, the underlying long-term path of progress. Over the long haul, economies tend to grow, companies get more profitable, and markets generally rise. This is the big picture reality.
But of course, life, it never moves in a perfectly straight line, does it? That straight line is just a long-term average. The reality is that wavy line oscillating around it. And why does that wave exist? Well, it's us. It's people. Our psychology, our greed, our fear, that infectious sense of optimism, that's what pulls and pushes everything away from that nice steady trend line, creating the very cycles we live through.
Okay, so we've got the basic picture. Now let's really zoom in on that wave. Let's dissect it and see if we can find the repeatable pattern that's hidden in there, moving from peak to trough and back again.
So here's our diagram again, but now we've put some labels on it. And see, this isn't just some random squiggle. Each of these letters, from A all the way through H, they mark a specific, really identifiable phase in the journey around that central trend line. It's a roadmap.
And what's so cool about this is how it breaks that whole journey down into a clear 6-step process. It shows you the rhythm of the cycle. You can see how we start way down at the bottom, the trough, at step 6, and then we start to recover, that's step 1. We expand all the way up to a peak at step 3, before, you guessed it, we correct and decline back down to start the whole dance all over again. It's a predictable rhythm.
You know, this brings up a really crucial question. Where does a cycle actually begin? And the simple answer is, it doesn't. This great story about Henry Kissinger illustrates it perfectly. Every single event is just one link in a massive chain reaction. If you want to understand why we're at a peak today, you absolutely have to understand the trough that came before it. There's no real start or end, just a continuous flowing process.
So that midpoint, that secular trend line, you can think of it as having this kind of gravitational pull. When things get too high or way too low, there's this powerful force that wants to pull everything back to the average. But, and this is the absolute key, the momentum, the psychology that pulls it back, it doesn't just magically switch off when it hits the middle. It almost always overshoots the mark and carries the swing all the way to the other side, to the opposite extreme.
Okay, let's pause here, because we're about to get to what I think is the single most important idea in this whole thing. This is the concept that really unlocks the entire mystery of cycles. It moves us from just watching them happen to truly understanding why they happen.
So here it is. This is the crucial shift in thinking. See, most people look at it and they think, okay, there was a boom and then a bust followed it, one thing after another. But that's not really what's happening. The deeper truth is that the boom causes the bust. The downswing isn't some separate event. It's a direct consequence, a direct result of the excesses that were built up during the upswing. One literally gives birth to the other.
Think of it like a pendulum. It's really the perfect way to picture the physics of it all. As you pull that pendulum to one extreme, you're building up all this potential energy, right? And when it gets to the very top, the peak, well, it has to stop. And in that moment, all that stored energy gets released, and that's what powers the swing all the way back. But crucially, just like a real pendulum, it doesn't just stop in the middle. Its momentum carries it right on past and all the way to the opposite extreme.
And you know what? The size of that swing, it matters a lot. You get a small, healthy little upswing, you're probably going to get a small, healthy little correction. But when you get a massive, speculative boom, a full-on bubble, well, that stores up a terrifying amount of energy. And when that pendulum finally reverses, the snapback isn't some gentle correction. It's a crash, it's a bust, it's a panic. The boom itself creates the very conditions for its own violent destruction.
And it's so important to remember that none of this happens in a vacuum, right? These cycles are all interconnected. Just think about it. The economy's doing great, so company profits go up. Profits are up, so investors get all optimistic and the stock market soars. The market's soaring, so banks feel good about lending money, which then just pours more fuel right back into the economy. It's this giant self-reinforcing loop where each cycle feeds on the others.
Okay, so if the mechanics of the cycle are like physics, what's the fuel? What's the energy that's actually being stored up in that pendulum? Well, it's us. It's pure, unadulterated human psychology. Our emotions, they're the engine.
So why? Why do we keep making the same mistakes over and over again? The economist John Kenneth Galbraith, he nailed it. He talked about the extreme brevity of the financial memory. We just forget. The intense pain of the last crash just kind of fades away, and it gets replaced by this fresh new wave of optimism. A new generation of investors comes along who didn't live through the last bust, and they are so sure that this time is different, that the old rules just don't apply anymore.
You know, it's funny, even the way we talk about cycles is totally biased. Just look at the words we use. On the downside, we've got all these scary, dramatic words. Volatility, selling panics, capitulation. I mean, they sound dangerous, because they are. But on the upside, a positive swing is just profit. A market surge is just great news. In reality, they're two sides of the same coin. A wild surge driven by greed, that's a buying panic. It's every bit as irrational as a selling panic. And when cautious investors finally throw in the towel at the top because they're terrified of missing out, that's capitulation too. The danger is absolutely equal at both extremes, but our brains, our psychology, we only seem to get scared on the way down.
Okay, so now what? How can we actually use all this stuff? All right, in this last section, let's talk about how to turn all this theory into a practical map for navigating the world around us by looking at the past through just the right lens.
You've probably heard this famous saying, often credited to Mark Twain, and it is the absolute bedrock of thinking about cycles. What it means is, the details are always going to be different, but the underlying themes, the human behaviors that drive these things, they are timeless. They come back again and again.
So what does that actually mean? Rhyming? Well, it means you got to stop looking for an exact copy of the last crisis. The next blow-up probably won't be caused by subprime mortgages, you know? That's just a detail. Instead, you got to look for the themes that recur again and again. Is there just way too much optimism out there? Has everyone forgotten how to be cautious? A real shortage of risk aversion? Are banks and investors just throwing money at anything that moves? Those are the universal warning signs of a cyclical peak, and they show up every single time.
And all this leads to one fundamental, inescapable truth. Cycles are inevitable. You'll see things go up for so long that people become 100% convinced it's never going to stop. And that's when you start to hear those 4 most dangerous words in the entire financial world. This time, it's different. But you know what? It almost never is. That pendulum always, eventually swings back.
And when that swing back does happen, and it will, I want you to remember this one analogy. Think of a balloon. It can take years and years to inflate it, just slow and steady, pump after pump. But the bust, the pop, that can happen in an instant. The air rushes out, and fortunes that took years to build can be wiped out in weeks, even days. The downside is almost always faster and more violent than the upside.
So, at the end of the day, the fact that cycles exist, that's not really up for debate. They're just a fundamental part of how things work. The real challenge, the question we should all be asking ourselves as we look at the world around us, is much simpler and much harder. Where are we in the cycle right now? Answering that, now that's the real game. Thanks for digging into this with me.
You know, we all have this thing, right? This deep-down need to find simple, winning formulas for life. We crave predictable patterns, especially when our money's on the line. But here's the thing that can be tough to swallow. We live in a world that is just fundamentally deeply affected by randomness. And that makes the future, especially in finance, a whole lot less predictable than we'd like to believe. So, in this explainer, we're going to go on a bit of a journey together. First, we'll look at why we're so hardwired to see patterns everywhere. Then, we'll dive into this amazing story about a debate over what the word cycle even means. After that, we'll explore the 2 big forces at play, randomness and good old human nature. We'll look at the dangers of what I call the predictability trap, and then, and this is the best part, we'll figure out where the real advantage is, and that's in embracing uncertainty. All right, let's start with our own psychology. This first part is all about that hunger for patterns, this core human drive to find some kind of order, some kind of rules, in what can often feel like a pretty chaotic world. It's really about making life feel safer, you know, more manageable.
And that really brings us to the biggest question of all. Why do we do this? I mean, when we're staring at the insane complexity of markets and economies, why is our first instinct to search for some simple, repeatable rule?
Well, the answer is actually pretty straightforward. We do it because we are just not comfortable with randomness. The idea that huge outcomes in our investments, our careers, you name it, could just be influenced by pure chance, that's unsettling. It makes us feel like we're not in control. So naturally, we search for explanations, for rules that make it all make sense.
And listen, this isn't some modern financial quirk. This instinct is ancient. It's evolutionary. Think about it. Early humans who got good at recognizing patterns were the ones who survived. They figured out pretty quick it was a bad idea to visit the watering hole at the same time as a pride of lions. They learned that if you plant crops in the spring, you eat. This drive to find patterns is literally baked into our DNA.
Okay, now I want to tell you a story that just perfectly captures this whole tension. It's about a debate that happened over lunch, where a simple little disagreement about one word, the word cycle, ended up revealing a massive truth about how markets really work.
So the story kicks off with an email from a money manager in London named Nick Train. He'd read something the author had written and basically said, hey, I don't like how you're using the word cycle when you talk about markets. And that little email sparked a whole debate, which eventually led to a pretty spirited lunch meeting.
This slide really nails the heart of their disagreement. It's like 2 totally different ways of seeing the world. On the left, you've got Nick's view. It's scientific, it's physics. To him, a cycle is like a perfect sine wave. It's regular, it's predictable, the timing is fixed, and it always goes back to where it started. But then you look on the right, and that's the author's view, which is all about the messy reality of people. A market cycle, it's not clean. It's unpredictable, the timing is all over the map, and it's driven by the chaotic, emotional whims of investor psychology.
So Nick's argument was really rooted in science, in math. He was basically saying, look, if you're going to call something a cycle, it has to be consistent. The timing, the highs, the lows, all of it needs to be regular enough that you can actually predict it. It's a very logical, very clean definition.
But the author's comeback was way more pragmatic, It was based on just watching how people behave. He argued that in the world of investing, a cycle is simply the fact that things go up and then they come down. And the whole key, is that when things are going up, people start to believe they'll go up forever. And when they're going down, people think they'll never recover. And right there, in that emotional extreme, that's where the opportunity is. Betting against that can be incredibly profitable.
So, if market cycles aren't these nice, clean sine waves, why not? Well, that brings us to our next section, where we explore the two hidden forces that make everything so darn unpredictable: randomness and human nature. And you'll see that this irregularity isn't a bug in the system, it's a feature.
This quote from Leonard Mladinov's fantastic book, The Drunkard's Walk, just hits the nail on the head. Our brains are basically cause and effect machines. We have such a hard time accepting that sometimes success or failure isn't about skill or being dumb, it's about what one economist called fortuitous circumstances, just plain luck.
Okay, think about Hollywood for a second. The legendary screenwriter William Goldman had this famous line, "In the movie business, nobody knows anything." He argued that why a movie becomes a huge hit is so complicated and vulnerable to so many random things that even the smartest guess from a studio boss is basically just a coin flip.
Or how about this one? A single at-bat in baseball. Of course, a player's skill matters, but so do 1,000 other random variables. The wind, the sun in their eyes, the exact pitch they get, the pressure of the game situation, their hand-eye coordination in that one split second. Heck, even what they ate for breakfast can play a role. All these unpredictable factors mean even the best player in the world isn't going to hit a home run every time. Randomness is always in the game.
And this is what illustrates the point for us as investors so brilliantly. These exact same kinds of uncontrollable variables are absolutely everywhere in economics. A company can have a fantastic earnings report, but its stock tanks because the Fed decided to raise interest rates that very same day. This is why these simple if A then B rules are just so often unreliable.
And this leads us right into a really important cautionary tale about something called the predictability trap. This is where we make the classic mistake of seeing a coincidence and thinking it's a cause and effect rule, all because we want to believe a pattern exists.
So let me give you a real-world example from the world of high-yield bonds. For a while, this little rule started circulating that these kinds of bonds tended to default right around their second birthday. Now, if that's true, that's an incredibly valuable piece of information for an investor, right?
But you have to stop and ask the critical question here. Was this actually a helpful rule based on real logic, or was it just a dangerous assumption based on a fluke?
The reality? This rule was born from our hunger for simple formulas, not from any kind of serious analysis. What most likely happened is that a few defaults just happened to cluster around the 2-year mark by pure chance, and people saw it and created a pattern that wasn't really there. Coincidence is not causality.
And this is where that incredible quote, often credited to Mark Twain, is just so perfect. History may rhyme, but it rarely repeats exactly. Past patterns can be a useful guide, for sure, but they are never, ever a perfect blueprint for the future because those random variables are always changing.
So, you might be thinking, if we can't rely on perfect patterns, are we just lost? And the answer is absolutely not. Which brings us to our final and I think most important section, finding the edge in uncertainty. It's all about realizing that accepting unpredictability is actually the key to getting a real advantage.
We just have to be honest with ourselves about what we'll never know. We are never going to know exactly when a cycle will turn, how high or low it will go, or how fast it's going to move. Trying to predict those things with any kind of precision is just a fool's errand. There's a whole lot we just have to admit we don't know.
But, and this is the most important but you'll hear today, there is one thing we do know with a pretty high degree of confidence.
We know that the cycles of rising and falling, the ones driven by those big swings in human psychology from greed to fear, are going to keep happening. That is the one constant we can really hang our hats on.
And so, I want to leave you with this final, powerful question. This whole thing isn't about prediction, it's about preparation. If you know you can't predict the exact timing of the next turn, the real question becomes, how do you prepare yourself for it? How do you position yourself to survive the downturns and be ready to capitalize on the opportunities they always create? That, right there, that's where the real edge is found.
Hey there, and welcome. You know, I've been watching the markets for a good few decades now, and if there's one thing I've learned, it's that we are constantly bombarded with economic news. It can feel, well, pretty overwhelming. So today, I want to share a really simple but powerful framework that I use to cut through all that noise and get a handle on the forces that are really shaping our world. I mean, it really does feel like a roller coaster, right? One minute you're hearing about record growth and everything's great. The next, everyone's talking about a looming recession. It just seems chaotic, totally random. But what if I told you there actually is a pattern to all this madness? Stick with me, because by the end of this, I think you'll have a much clearer way to see it. All right, so let's dive right in. The very first step, the most crucial thing to understand, is that you have to stop thinking about the economy as one single thing. You have to separate it into two very distinct speeds, two different currents that are both happening at the same time. So speed number one is this, the long-term trend. Sometimes you'll hear people call it the secular trend. Now, don't let that word throw you. It just means something that unfolds over a really long time, like decades. The best way to think about it is like a massive, slow-moving river current. Underneath all the daily drama and the headlines, there's this surprisingly steady, powerful, upward trend. This is the fundamental direction the economy's heading over the long haul. And this visual? Well, this is speed number two. This is where most of the headlines live. These are the short-term ups and downs, the recessions and the recoveries that wiggle around that main trend line. So if the trend is that deep river current, these are the waves on the surface. They get all the media attention for sure, but they're really just fluctuations around that deeper, more powerful movement. Okay, so if that long-term trend is the foundation for everything, what's actually powering it? What are the gears that are turning that deep river current forward? Well, you might be surprised to find out it's actually way more mechanical and a lot simpler than you might think. It all really comes down to a simple way of thinking about gross domestic product, or GDP. Now, technically, it measures the total value of everything an economy produces, but for our purposes, you can break its growth down into a really simple formula. The total number of hours people work multiplied by how much stuff they produce in each one of those hours. Honestly, if you can grasp this basic equation, you've unlocked the key to understanding long-term economic growth. So the crucial point here is that this engine, it really only has two main parts. First, you need more hours worked. That's mainly driven by population growth, right? More people means more potential workers. And second, you need those workers to get more efficient, what we call productivity gains. That's it. These two things are the fundamental slow-moving gears that determine just how fast an economy can grow over decades. And you can really see where those big productivity gains come from when you look at a timeline like this. They don't just happen little by little. They tend to arrive in these massive, multi-decade technological waves. Think about it. From the steam engine that kicked off the Industrial Revolution all the way to the AI and big data of today's information age. These huge shifts are what truly put our output into overdrive, and in turn, power that long-term growth. Now, of course, it's not just about population and technology. There are other powerful, slow-moving forces at play here. Things like the migration of people from farms into cities, the overall education level of your workforce, even cultural things like the profit motive, and of course, massive trends like globalization. All of these help shape that long-term trend line over many, many years. So if that long-term trend is driven by these slow, steady, almost mechanical forces, why on earth do we experience such wild, stomach-turning swings from one year to the next? What's causing all those waves on the river's surface? Well, here's the secret ingredient. It's us. It's people. Our collective psychology, our emotions, and the often pretty irrational way we all make decisions. These are the primary drivers of that short-term economic roller coaster. So, here's the key idea. The potential for an economy to grow is set by those mechanical, long-term factors we talked about. But the actual growth in any given year, that's determined by us. Our willingness to go to work, to spend our money, to invest in a new business. None of that is constant. It changes based on how confident or, well, how fearful we feel about the future. Let me give you a perfect example of this psychology in action. It's called the wealth effect. When the stock market is going up or home prices are rising, people they feel richer. And here's the crazy part. Even if their actual paycheck hasn't changed one single bit, that feeling of being wealthier makes them go out and spend more money. This directly fuels economic booms, and it's driven entirely by our perception, not just our income. And the triggers for these feelings are everywhere. Good headlines in the news, what we think will happen after an election, banks making it easier to get a loan, that wealth effect we just talked about. Heck, research has even shown that something as seemingly trivial as your local sports team winning a championship can boost consumer spending. Our decisions are swayed by this whole cocktail of rational and emotional factors, and that's what creates those unpredictable short-term swings. So this brings us to a really big question. If we understand these long-term mechanical forces and these short-term psychological drivers, can't we just predict the turns? Well, let me tell you, from my experience, trying to predict the future of the economy is a very, very humbling business. This slide just perfectly breaks down the forecaster's dilemma. On one hand, you've got what are called extrapolation forecasts. These just assume that whatever is happening now will keep happening. And you know what? They're usually correct. The problem is, because everyone already expects it, they're not very valuable. On the other hand, you have unconventional forecasts that predict a major turn. If you get one of these right, wow, it's incredibly valuable. The catch? They are almost always wrong. The great economist Milton Friedman, he put it perfectly. Most forecasters, they're all looking at the same data, trying to guess what everyone else is going to say. Their predictions will be moderately right, meaning, yeah, they'll correctly predict that the trend is going to continue. But because that's what everyone thinks, it gives you no edge, absolutely no advantage. And I absolutely love this classic quote from John Kenneth Galbraith. It really just summarizes the whole game. The short-term economy is so driven by unpredictable human psychology that anyone claiming to know for sure what's coming next, well, they probably fall into one of these two camps. It just requires a fundamental humility. Okay, so let's take this framework we've built, this idea of a long-term trend and a short-term cycle, and let's apply it to a major unexpected event from recent history. This is where you can really see how it helps you think more clearly when something big and unexpected happens. But before we jump into our example, let's look at this chart one last time. This is that river's current we've been talking about. The biggest question after any major shock isn't just about the immediate waves it creates. The real question is this event powerful enough to permanently alter the course of the river itself? That's the lens we need to use. And I think a perfect event to examine through that lens is the Brexit vote. Yeah, the Brexit vote in 2016 is a perfect case study. First, it was a massive forecasting failure. The experts, the markets, the bookies, pretty much everybody got it wrong, which just proves our point about trying to predict these things. Second, it had an immediate short-term impact. The shock and the uncertainty, it hit consumer and business psychology hard, creating fear that could slow down economic activity right away. And third, it raised this profound long-term question. Did this single event fundamentally bend that long-term trend line for the UK and for Europe for decades to come? It's a perfect example of one jolt that affects both the short-term waves and potentially the long-term current. So, that's the framework. A slow, mechanical, long-term trend driven by population and productivity, and a volatile, psychological, short-term cycle that bounces around it. It's a really powerful way to filter the daily news. It even makes you wonder if what we call the long-term trend is just one phase of some even bigger, multi-generational cycle that's just too vast for us to fully see. So I'll leave you with this question to think about. Using this framework, what's happening in the world right now? Some political event, some new technology that might be powerful enough to not just create short-term waves, but to actually bend the river's current and to redirect our economic future for decades to come.
The economy can feel like this massive, untamed beast, right? One minute it's roaring ahead, the next it's in a deep slump. So the big question is, who's actually trying to get a handle on it? Well, today, we're diving into how governments and central banks attempt to steer this thing, trying to smooth out those inevitable, and let's be honest, often painful, swings.
So why does any of this matter? Why even bother trying to manage the cycle? Well, because the extremes cause real, actual harm. When the economy gets way too hot, you get runaway inflation. Suddenly, the money in your pocket doesn't buy what it used to. But on the flip side, if the economy gets too weak, businesses start to fail, and people lose their jobs. No matter how you slice it,
The stakes are incredibly high for all of us.
All right, so here's our game plan. First, we're going to talk about the economic roller coaster itself. Then we'll meet the two main players in this story, central banks and governments. We'll look at their different philosophies, the hawks and the doves, and the tools they use. Then we'll get into a major dilemma they face, and we'll wrap it all up by asking the big question: can this cycle even be managed at all?
Okay, let's jump right into part one, the economic roller coaster. It really all starts with understanding why anyone feels the need to step in the first place.
Now, the first thing to get is that nobody's trying to stop the cycle. That's not the goal. These ups and downs are just a natural part of how a market economy breathes. The real idea here is to act like a shock absorber for a car. To make the booms a little less crazy and the busts a lot less painful. And this whole strategy actually has a name. It's called counter-cyclical policy. It's a pretty simple but powerful idea. You just lean against whichever way the economic wind is blowing. When things are getting too hot, you tap the brakes. And when things are getting cold, you hit the accelerator. This concept right here is the key to everything we're going to talk about. So let's bring on the first major player trying to do this, the central bank. And their job, honestly, is like a constant tightrope walk, using something called monetary policy.
It wasn't always this way. Central banks used to just be about, printing money. But their role has totally evolved. Today, for big institutions like the U.S. Federal Reserve, their number one job is managing the economic cycle.
And this is where that tightrope walk gets really, really tricky. You see, most central banks are working under what's called a dual mandate. This means they have two main jobs that are basically fighting each other. Keep inflation low, but also keep employment high.
Just think about that for a second. To fight inflation, you have to slow the economy down. But to create more jobs, you need to speed the economy up. A central banker literally cannot do both of these things at the same time. Every single decision they make is a trade-off. It's a constant tug of war between these two opposing goals.
So because of this built-in conflict, you naturally end up with two different schools of thought inside any central bank. We call them the hawks and the doves. First up, you've got the hawks. A hawk's biggest nightmare is inflation spiraling out of control. So their instinct is always to lean towards restraint, to be cautious. Their favorite tools are things like raising interest rates or shrinking the money supply, basically anything that will cool the economy down. And then on the other side of the table, you have the doves. What keeps a dove up at night? High unemployment. So their natural tendency is to push for stimulus. They're the ones who want to lower interest rates and expand the money supply, all to encourage more borrowing and spending to help create jobs. But hey, central banks aren't the only ones in this game. Let's talk about the government's role. They have their own set of tools, which we call fiscal levers, and it all comes down to the power of taxing and spending.
So let's say the economy is in a slump. The government's playbook for stimulus is pretty straightforward. They can cut taxes, which leaves more cash in you and my pockets. Or they can ramp up spending on big projects like roads and bridges. Either way, the result is more money flowing through the economy, which boosts demand.
And of course, the reverse is true, at least in theory. If the economy is overheating, the government can try to cool it down by doing the opposite. They can raise taxes or cut back on their spending. This effectively pulls money out of the economy, which should lower demand and take some of the air out of the boom. Now, this whole idea of using government, taxing, and spending to manage the economy, it was really made famous by one economist, John Maynard Keynes. But his theory has one major real-world problem.
See, Keynes's idea was all about balance. He said that when the economy is weak, governments should spend more than they take in. They should run a deficit to get things going. But, and this is the part people forget, when the economy is strong, they're supposed to do the opposite, run a surplus, collect more in taxes than they spend to cool things off and pay down that debt.
And right there, that's the dilemma. Stimulating the economy is almost always popular. I mean, who doesn't like tax cuts or new spending programs? But what about the other side of the coin? Is it ever politically easy to raise taxes or cut spending when things are going great and everyone is happy? I mean, let's be real. It's an incredibly tough sell. No politician wants to be the one who takes away the punch bowl right when the party is really getting started. They don't want to be the wet blanket. So what's the end result of this political reality? Well, we basically only ever do one half of what Keynes suggested. Governments are usually pretty quick to run deficits when times are tough, but they almost never run surpluses when times are good. It's gotten to the point where government surpluses have become, as the source material puts it, as rare as buggy whips.
So, let's pull all these threads together now and face the tough reality of this whole balancing act. After everything we've talked about, is it even possible to manage this economic cycle?
Well, a huge piece of the problem is that both the central bankers and the politicians are kind of flying blind. For all the data and all the experts they have, their insight into the cycle is limited, and it's uncertain. They're not totally sure where we are on the cycle right now, much less where it's going next. It really is like trying to steer a massive ship in a thick fog.
So when you add it all up, the core challenge is just immense. You've got these goals that are actively fighting each other. The tools you have aren't precise surgical scalpels, they're more like sledgehammers. Political pressure constantly gets in the way of doing the sensible but unpopular thing. And on top of it all, trying to get the timing and the intensity just right is, well, it's next to impossible.
Which leaves us with one final, pretty unsettling question. If managing this whole thing is this difficult, with all the conflicting goals and political pressures and just plain uncertainty, are these painful booms and busts just an inevitable part of our economic reality? Is this just something we have to live with? That, I think, is the real question to chew on. You ever look at the stock market and just wonder why it's so dramatic? You know, the economy gets a little bit better and suddenly company profits are through the roof. But if there's even a hint of a slowdown, those same profits just fall off a cliff. Well, that's not just your imagination. It's a real phenomenon. And today we're going to pull back the curtain and figure out exactly why business fortunes are on such a wild roller coaster.
Okay, let's just dive right in. This slide really lays out the central mystery we're tackling. On the left, you've got the overall economy, GDP growth. In a place like the US, its yearly growth is usually in a pretty tame range, maybe between plus 5% in a great year and minus 2% in a bad one. But then you look to the right, that's corporate profits, and whoa, they swing so much more wildly. They can shoot way past 5% on the upside and plunge far deeper than 2% on the downside. So the big question is, why? Why is the profit cycle so much more volatile than the economic cycle that's supposed to be driving it?
To get to the bottom of this, here's our game plan. We'll start with the profit roller coaster itself, then we'll see why not all sales are equal. After that, we get to the really fun stuff, the first magnifier and the second magnifier that blow up these changes. We'll also look at the wild card of disruption, and then finally, we'll put it all together into a framework you can actually use.
All right, let's kick things off with part one, the profit roller coaster. This is really about understanding this tale of two cycles, the relatively calm economic cycle versus the much, much wilder profit cycle.
So, like we said, US GDP growth tends to be pretty contained. You might only see those extremes, a 5% boom or a 2% contraction, maybe once a decade, if that. But here's the thing, that stability just doesn't carry over to a company's bottom line. For businesses, those small economic shifts are just the beginning of the story. The final impact gets magnified, and it's that magnification that causes profits to soar and crash with way more intensity than the economy they're built on. Okay, so let's move on to our first big clue in this mystery. Section 2, not all sales are equal. This is where we start to see that a rising economic tide definitely does not lift all boats in the same way. You see, some industries are what we call cyclical. Their sales are incredibly sensitive to the economy's ups and downs. Think about the big purchases, cars, homes, or even the industrial metals needed to make them. When times are good, sales go crazy. When times are bad, they just dry up. Then, on the other side, you've got non-cyclical industries. These are the things we need no matter what. Food, medicine, even a basic haircut. People buy this stuff pretty consistently, whether the economy is booming or busting.
So why are those big, durable goods so sensitive? Well, there are three really good reasons. First, you can put off buying them. If you're worried about your job, that new car can wait another year. Second, they're expensive. It's just plain harder to scrape together the cash for a new fridge during a recession. And third, from a business perspective, companies only buy a ton of new equipment when they're expanding, and they only expand when the economy is looking bright. It's a triple whammy that makes their sales incredibly volatile.
And this brings us to where things get really interesting. We've seen how sales can swing wildly, but now we're going to see how that swing gets amplified. Welcome to Section 3, the first magnifier, operations. This is all about a company's internal costs and a powerful concept called operating leverage.
So what on earth is operating leverage? Well, in simple terms, it's all about a company's mix of fixed costs versus variable costs. The more fixed costs you have, stuff you have to pay no matter what, like rent, the higher your operating leverage. And that leverage acts like a lever, magnifying every little change in your sales into a much bigger change in your profits. The British have a fantastic term for this. They call it gearing, and it really gives you that feeling of mechanical power, doesn't it?
Let's make this super simple. Imagine we're running a taxi cab company. We've got pure fixed costs, like the rent for our office. It doesn't matter if we do 1 ride or 1,000 rides, that rent check is the same every month. Then we have semi-fixed costs, like the cabs themselves. A few more rides a day doesn't mean we need a new car, but a huge sustained boom in business might. And finally, we've got variable costs, like gasoline. Every single extra ride we give directly increases how much we spend on gas. And here's the absolute key. Let's say our taxi business is booming and revenues jump by 20%. Well, our gas costs will go up by 20%, sure. But our office rent? It doesn't go up at all. This means our total costs go up by way less than 20%. And since profit is just what's left over after you pay your costs, that 20% bump in revenue leads to a much, much bigger jump in profits. That's operating leverage working its magic. But, and this is a huge but, it's a double-edged sword. A 20% drop in revenue can cause a truly catastrophic plunge in profits for the very same reason.
But hold on, because we're not done magnifying things yet. Let's move to Section 4, the second magnifier, debt. If operating leverage is about amplifying sales changes into operating profit, while financial leverage takes that operating profit and amplifies it again on its way to the final numbers shareholders actually care about.
So financial leverage is just a fancy way of talking about using debt, borrowed money to run a business. And think about it. Just like your office rent, the interest you pay on that debt is another fixed cost. Come rain or shine, good quarter or bad quarter, the bank wants its interest payment. That fixed payment has to be covered before the actual owners, the shareholders, see a single dime. And that creates another incredibly powerful magnifying effect on their returns. Let's look at a quick scenario to see this in action. We've got 2 identical companies, A and B. They both have a rough year, and their operating profit, that's their profit before they pay any interest, drops by 1/3, from $3,000 down to $2,000. Now, Company A is totally debt-free, financed only by its owners. But Company B is 50% financed with debt, and it has a fixed interest payment of $1,500 it has to make no matter what.
And here is the punchline. For Company A, the debt-free one, that 33% drop in operating profit is exactly what the owners feel. Their net income also falls by 33%. Simple enough. But now look at Company B. That exact same 33% drop in operating profit causes its net income to absolutely crater from $1,500 all the way down to just $500. That is a jaw-dropping 67% collapse. The fixed cost of interest just magnified that downturn for the shareholders, big time.
So, we've got the economy, we've got sales sensitivity, we've got operating leverage, and we've got financial leverage. It kind of sounds like a big, complicated but predictable machine, right? Well, there's another force out there, one that's anything but predictable. This is Section 5, the wild card, disruption. This is what happens when something from completely out of left field changes the entire game.
Let's hop in a time machine and go back to the 1990s, and let's look at the newspaper industry. I mean, back then, these guys looked unstoppable. They were essential. They had total monopolies on local advertising. If you were a small business, you had to be in the paper. This created what investors call a moat, a huge barrier that made it almost impossible for a competitor to challenge them. Their stocks were considered defensive, boring, safe, stable moneymakers.
And then the internet showed up. It wasn't an economic cycle. It was a complete shock to the system, a technological disruption that blindsided the entire industry. Seriously, who in 1995 could have possibly predicted that in less than 20 years, this bedrock stable industry would be in a fight for its life? It is the perfect and painful example of how disruption can just steamroll all the normal cycles.
Okay, we have covered a ton of ground. So now it's time for our final section, putting it all together. Let's take all of these different pieces and assemble them into one single framework that you can use to understand why a company's profits move the way they do.
So here it is, the profit amplification chain. It all starts at the top, with the big economic cycle. Is the economy growing or shrinking? That gets filtered through a specific company's sales sensitivity. Are they selling cars or are they selling aspirin? Then, whatever change is left gets amplified by its operating leverage, its mix of fixed and variable costs. That amplified number gets amplified again by its financial leverage. How much debt are they carrying? And layered on top of all of that, you have to remember the wild cards, those shocks like new technology that can change everything overnight.
And all of this leaves us with one final, really important question for the world we live in today. You know, a few decades ago, the world felt a lot more stable, and these economic cycles just kind of played out predictably. But today, It feels like everything is changing all the time. So as the pace of change keeps getting faster and faster, which of these cycles do you think really matters more for a company's future? Is it the predictable up and down rhythm of the economy, or is it the powerful game-changing and totally unpredictable shocks of the disruption cycle? It's definitely something to think about. Thanks for tuning in.
Welcome to The Explainer. Today, we are diving into a really powerful idea from the legendary investor Howard Marks. It's a metaphor, really, but one that gets right to the heart of why markets seem to go crazy sometimes. It helps us answer one of the biggest questions in all of finance.
And that's a brilliant question, isn't it? I mean, think about it. The real economy, it kind of ebbs and flows, right? It might grow a couple of percentage points, maybe it shrinks a little, but financial markets, whoa, we're talking wild swings, plus or minus 30–40%. So what on earth causes that huge disconnect? Well, the answer isn't buried in some complex financial report. It's not in the earnings data. It's actually a lot closer to home. It's inside our own heads. And this quote just nails it. This is the big idea we're going to unpack today, the pendulum of investor psychology. It's this fantastic concept that really explains the emotional cycles that don't just influence the market, they drive it. The key takeaway here is that for investors, emotional extremes, they aren't the exception. They're pretty much the rule. All right, so what is this psychology pendulum really? And why is it so important for anyone trying to make sense of the markets? Obviously, it's not a real physical thing. It's a way to picture the collective mood, the emotional state of millions and millions of people all at once. Now, I want you to focus on that one word, dependable. This isn't just some random chaotic thing happening. What Howard Marks is saying is that this swing of emotions is one of the most reliable, most predictable features of the entire investment world. The market is hardly ever just calm and rational and balanced. It's almost always on its way from one extreme to the other. So this pendulum, it doesn't just swing back and forth randomly. It moves between very specific, very powerful emotional poles. And these feelings, they're all connected. You get one, and the others are usually right there with it. Let's take a look at some of the big ones. Okay, this is the classic. This is the big one. Greed versus fear. When things are looking good, greed just takes over. People get fixated on how much money they can make, they start competing with each other to buy assets, and all that bidding just pushes prices higher and higher. But then when the mood sours, fear completely takes over, and that worry about losing money, it totally crowds out any desire for gain. Now, these are the feelings that are really powering that greed and fear. You can't really have that intense greed without euphoria, that kind of giddy, nothing can go wrong feeling about the future. And on the flip side, you have depression, which is what gives that fear its real teeth. You just can't be fearful and euphoric at the same time. And this one's all about what we expect is going to happen next. Our expectations for the future, they have a huge direct impact on our willingness to put money into the market. Optimism is the fuel for greed, right? It's the belief that good things are just around the corner. Pessimism, though, that fuels fear and makes us want to run for the hills. And finally, just look at this. Look at how our appetite for taking chances changes. When the market is euphoric and everyone's greedy, investors become incredibly tolerant of risk. I mean, they'll buy just about anything. But when that fear takes hold, that tolerance just vanishes. It's gone. And it's replaced by this intense avoidance of any possible loss. You know, all this talk about swinging from one extreme to the other, it brings up a really interesting problem with how we usually think about the markets. We hear about average returns all the time, but this whole pendulum idea shows us that average is pretty much just a comfortable illusion. It's something we almost never actually get to experience. Yeah, this is the number everybody knows, right? 10%. It's the supposed middle point of the pendulum's swing, the happy medium. It sounds so reasonable, so stable, maybe even a little bit boring. But the reality? Oh, it is anything but. So let me ask you this. How often does that pendulum actually come to rest right there in the middle in that comfortable average? I mean, if the average is 10%, you'd think it would land somewhere near there pretty regularly, right? Well, the real answer is, it's genuinely shocking. Just three times. Let that sink in for a second. In almost half a century of investing, the market gave us what you'd call an average return, only 3 times. That's it. Honestly, that one single fact should completely change the way you think about how markets work. And here's the real kicker. It's not just that average is rare, it's that extreme is common.
For more than a quarter of those 47 years, the return was wildly different from normal. And that's not just because companies did great or did poorly, it's because our collective psychology, that pendulum, swung to its absolute limits. This emotional swing, it does more than just mess with our feelings. It fundamentally changes how we see the world, how we interpret objective, cold, hard facts. Our collective mood basically becomes a filter that all news has to pass through. Or, to put it another way, the news itself doesn't change nearly as much as our reaction to the news. When we're feeling good, we tend to only see the positive stuff. And when we're feeling bad, we only notice the negative. Our interpretation of reality gets completely bent out of shape. And just look at this bias in action. It's incredible. In a bull market, when everyone's feeling positive, literally every piece of news becomes a reason to buy. Strong economic data? Great. Economy's strong, stocks go up. Weak data? Oh, that means the Fed will step in and help, which is also good for stocks. The story always bends to fit the happy mood, not the other way around. You know, this old cartoon caption just perfectly captures the complete absurdity of it all. The market story, its narrative, can flip on a dime depending on whatever the mood is that day. The exact same fact, in this case lower interest rates, gets spun as a positive, then a negative, then a positive again. It all just depends on where that pendulum is swinging. And this is the end result of that pendulum in action. It doesn't just swing a little bit, it careens from one totally unrealistic extreme to the other. We go from believing everything is perfect and nothing could possibly go wrong to believing everything is terrible and nothing will ever go right again. So, if most of us are just helplessly carried along by this emotional pendulum, how can anyone possibly do better than average? How can you get better results? Well, the answer isn't about trying to predict the swing. It's about learning how to resist it. Now, the key here isn't to be some kind of robot with no feelings. That's not realistic. It's about being aware of those powerful emotions, the greed, the fear, and having the self-control not to let them call the shots. It's about letting cool-headed analysis, not euphoria or depression, be your guide. But unfortunately, most of us, we do the exact opposite, don't we? We let the momentum of that pendulum just pull us along, usually right into trouble. We feel that urge to buy when everyone else is buying and prices are already sky high. And then we feel that panic to sell when everyone is dumping their stocks and prices are in the basement. So this is the playbook. This is the path forward. The superior investor knows you can't stop the pendulum. I mean, that's impossible. So instead, they just watch it. They recognize where it is in its arc, and they simply refuse to swing with it. They learn to see the emotional extremes of the crowd, not as a threat, but as an opportunity. And really, that's what it all comes down to. Understanding this whole pendulum idea, that's the first step. But having the discipline, the guts, to actually resist its pull, that is what truly separates the great investors from everyone else. The market is just one big game of mass psychology, and simply knowing the rules of that game, well, that's your greatest advantage.
You know, in a perfect world, we'd all be perfectly rational investors. We'd be diligent, we'd be skeptical all the time. But we don't live in a perfect world, do we? The reality is, our collective attitude toward risk, it swings back and forth like a pendulum, from just wild, unchecked optimism all the way to paralyzing fear. And that's what we're going to dig into today, this predictable yet so often irrational cycle.
I mean, this quote really just says it all, doesn't it? It perfectly captures this bizarre paradox. When the markets are flying high and things are actually at their most dangerous, that's when people are the most comfortable with risk. They only see the upside. But then, after a crash, when assets are on sale and the opportunity is actually greatest, everyone's terrified. All they want to do is stop the pain. It's a total flip-flop of emotion and logic.
And that really begs the central question we're going to explore. Why on earth do we do this? Why do we so consistently buy high and sell low? Why does our own psychology seem hardwired to do the exact opposite of what's rational? Figuring out this puzzle is, I think, the absolute key to navigating the markets without going crazy.
So here's how we're going to tackle it. We'll break it down to 4 parts. First up, we'll cover the basic theory of how risk and return are supposed to work. Then we'll look at the upcycle, when greed takes the wheel. After that, we'll dive into the down cycle, when fear is in charge. And finally, we'll pull it all together and talk about how you can actually master this emotional roller coaster.
All right, so let's start at the beginning. Before we can really get into the irrational stuff, we have to understand the rational framework that it all deviates from. This is how the investment world is supposed to function, on paper.
The whole entire system is really built on this one core idea, risk aversion. It's simple. Most of us, if you give us a choice between a sure thing and a gamble that has the same expected payoff, we're going to take the sure thing. We just don't like uncertainty. It's human nature. And because of that, to get us to take a risk, you have to dangle the possibility of a higher return in front of us. This trait is what keeps markets safe and sane. Well, most of the time.
And this chart here, this is basically the picture of that idea. It's called the capital market line. See how it slopes up and to the right? All that means is that as you take on more risk, you should expect a higher potential return. That upward slope exists for one reason and one reason only, because people are risk-averse. We demand to be paid for stepping out into the unknown.
Now, here is where a lot of people get tripped up. It's a really critical distinction. People see that upward sloping line and they think, awesome, more risk equals more money. Guaranteed. But hang on. If a riskier investment were guaranteed to give you a higher return, then by definition, it wouldn't be riskier, would it? The right way to think about it is this. For anyone to even consider a risky investment, it has to appear to offer a higher return. It's an invitation, not a guarantee.
And you can see how this theory creates a really logical pecking order in the real world. Down at the bottom left, you have super safe things like money markets. And as you move up that line, you get into treasuries, then corporate bonds, stocks, and way up at the top, you've got high-risk stuff like venture capital. Each step up the ladder of risk requires a higher promised return just to get people interested. This is the rational, orderly investment universe.
Okay, so that's the rational world. Now let's talk about what actually happens. Let's see how this nice, neat, rational structure starts to fall apart. This is what happens when the good times are rolling. When that healthy risk aversion starts to fade and greed begins to take over.
This slide really puts the psychological shift side by side. On the left, you've got your rational investor. They're cautious, they're analytical, they're skeptical. They demand a margin of safety. But during those euphoric times, a new kind of investor takes over. Caution? Thrown to the wind. Who needs to do analysis when everything's just going up? And skepticism? Well, that gets replaced by credulousness, a willingness to believe basically any story that sounds good.
So what does this do to our nice, orderly chart? Well, it flattens it out. And what does that mean? It means the rewards you get for taking on risk is shrinking. Investors, kind of drunk on optimism, are willing to pay higher and higher prices for risky things. That means they're demanding less and less potential return for taking on that extra risk. The payoff for being brave gets dangerously small.
And this is the feedback loop that creates a bubble. It starts with some good news, right? That fuels optimism. That optimism makes people forget about risk. And because they're not worried, they don't demand much compensation for taking risks, so they bid up asset prices. But here's the great irony. The higher the prices go, the riskier those assets become, creating the very conditions for the inevitable crash.
And this really brings us to the most important lesson of the upcycle. The real danger isn't a bad economy or some corporate scandal. No, the greatest risk of all is the widespread belief that there is no risk. When everyone is comfortable, when everyone thinks investing is easy, that is the moment of maximum peril.
Okay, but the party always ends, right? The music stops, so let's pivot and look at the other extreme of the cycle, when all that optimism evaporates and gets replaced by sheer panic and overwhelming fear.
After people have suffered really painful losses, their psychology just does a violent 180. That risk aversion that was completely missing at the top, it now becomes totally excessive. The memory of losing money is so painful that the only goal becomes avoiding any more of it. And that, of course, is what leads people to sell their assets at the absolute worst time, right at the bottom.
So now our capital market line does the complete opposite of what it did before. It becomes incredibly steep. This is the market basically screaming that it will offer an enormous potential reward to anyone who's brave enough to step up and bear some risk. The payoff is greatest precisely because almost no one is willing to take it.
There's this fantastic little story from the source material that just perfectly captures this mindset. An investment manager is presenting all this historical data on defaults, even showing the absolute worst-case scenarios. But the pension fund, totally paralyzed by fear, just keeps moving the goalposts, asking over and over, but what if it's worse than that? That's irrational pessimism. It's an inability to imagine any outcome other than total disaster.
So this leads to a really crucial insight. Being a good investor means you have to be a skeptic, but that is not the same thing as always being a pessimist. A true skeptic is a contrarian. They're pessimistic when everyone else's optimism is widespread and foolish. But Just as importantly, they're willing to be optimistic when everyone else's pessimism has become completely excessive.
Here's a number that just blows my mind, a stark example of that exaggeration. The source notes that from 1998 to mid-2002, the amount of corporate bonds that were classified as distressed grew by 8.5 times. Now think about that. Did the underlying reality of those businesses get 8.5 times worse? Of course not. No way. But investor fear did. Psychology takes reality and just exaggerates it wildly.
All right, so we've seen the euphoria and we've seen the despair. How do we actually use all this? Let's get to our final section and see how we can put this all together into a mental model that actually works. The key to mastering the cycle isn't predicting the future. It's just knowing where you are right now. This chart right here, this is the whole story in one picture. That straight line in the middle, that's the rational, fair value, the happy medium. But the market almost never spends any time there. As you can see from that wavy line, it's almost always in motion, either swinging way up toward an extreme of euphoria, like at point C, or plunging way down into an extreme of depression, like at point F. The superior investor understands this and just tries to figure out which part of that curve we're on.
So you have to wonder, why do we keep doing this? Why do these cycles repeat over and over again? Well, the economist John Kenneth Galbraith absolutely hit the nail on the head. We have an extremely short financial memory. The painful lessons of the last crash are forgotten so quickly, and a new, supremely confident generation comes along to praise old, disastrous ideas as brilliant new innovations.
And that leads us to the antidote, the solution. And of course, Warren Buffett boils it down perfectly here. Your behavior should be the inverse of the crowd's. When everyone else is being careless and imprudent, that's when you must become extra cautious. And on the flip side, when others are panicking and selling everything that isn't nailed down, that is the time for you to be prudent by being aggressive.
In the end, after everything we've talked about, it all comes down to this one simple, powerful question. For any investment you're ever considering, just ask yourself, how much good news and optimism is already factored into this price? If the price assumes a perfect future with nothing but sunshine and roses, there's very little room for upside and a whole lot of room for disappointment. But if the price reflects total despair with no optimism at all, then any tiny little piece of good news can lead to tremendous gains. It really is the best tool you have for figuring out where you stand in the cycle.
In the world of finance, there's this incredible force that can build fortunes and, just as quickly, wipe them out. And it's not the stock market. It's not even really the economy itself. It's something deeper, something more fundamental. We're talking about the credit cycle. So let's pull back the curtain on this thing and really get a handle on how it shapes our entire financial world.
This sentence right here, this is the key to everything we're about to go through. It just perfectly nails the violent, all-or-nothing nature of credit. See, it's not about these gentle rolling waves. It's about a flood of money followed by a sudden terrifying drought. This idea of a credit window, that's the concept we need to hold on to.
We're all glued to the news about GDP growth, corporate profits. And look, they matter. Of course they do. But they aren't the whole story, not even close. There's a much more powerful and, frankly, a much more volatile force at work just beneath the surface, and it's the thing that's really driving the booms and the busts.
This slide just lays it out perfectly. On the left, you've got the economy. It has its ups and downs, sure, kind of like rolling hills. A few percentage points here, a few there. Now, look at the right, the credit market. That's not a hill, that's a sheer cliff face. It's either wide open for business or it's slammed shut. There's very little in between. So, what are we really talking about here? I mean, the formal definition is the expansion and contraction in the availability of credit. But honestly, forget the textbook stuff. This credit window metaphor is the absolute best way to understand the whole cycle. Is the window open or is it shut? At any given time, that's pretty much the only question that matters.
So why is this such a big deal? Well, when that credit window is thrown wide open, it's like a turbocharger for the economy. It fuels growth, innovation, you name it. But when it's slammed shut, man, the consequences can be absolutely devastating. Because credit is the oxygen for business. It's not just for growth, it's for basic survival. Most companies don't pay off their debt, they just roll it over into new debt. If that window shuts right when their loan is due, even a perfectly healthy company can go bankrupt, just like that.
Okay, so let's dig into how this cycle actually plays out. And let's start with the good times.
Let's look at what happens when that credit window is thrown wide open and it feels like anything is possible.
You know, it always starts from a good place. The economy is humming along, everyone's making money, lenders and investors are doing well, and naturally they want to put more of that money to work. So far, so good. But then something happens. It's subtle. With so little bad news, people get this sort of collective amnesia about risk. It's like we all just forget that things can actually go wrong. And this kicks off this fierce competition among lenders. And to win deals, they start doing two things: lowering rates, and this is the big one, lowering their standards, which leads us to the inevitable, really dangerous conclusion. Money starts flowing to projects that in any sane environment would never, ever get funded.
It's such a strange paradox, but it is one of the most profound truths in all of finance. You'd think the biggest mistakes get made when everyone's panicking, but that's not it. No, they're made when confidence is at its absolute peak. As the old saying goes, the worst loans are made at the best of times. This is the key to understanding how every boom sows the seeds of its own destruction.
This frantic competition to lend money by lowering standards, it has a name. It's called the race to the bottom. It's this dangerous game where lenders are basically fighting to see who will accept the least amount of return for the most amount of risk. And it always, and I mean always, ends the same way, with a spectacular crash.
And here we go, the inevitable aftermath. And it becomes this vicious, self-reinforcing downward spiral. Those unwise loans we just talked about, well, they go bad, creating massive losses. This shock completely terrifies lenders, and that easygoing optimism is replaced by extreme, paralyzing fear. The credit window doesn't just close, it slams shut. This starves even good companies of the capital they need to survive. That leads to defaults, bankruptcies, which in turn just makes the economic downturn even worse and reinforces all that fear. It's a feedback loop from hell.
So this slide just boils it all down into one simple loop. This is it. This is the engine that drives the whole credit cycle. Prosperity breeds carelessness. Carelessness leads to losses. Those losses breed fear. Fear shuts down the lending, and that shutdown ends the prosperity. And then the whole thing starts all over again.
Now look, this isn't just some abstract model we talk about in finance classes. We have all lived through this cycle playing out in the real world, and with absolutely devastating consequences. So let's take a look at the most infamous example in modern history, the 2008 global financial crisis.
Just look at how fast the dominoes fell here. It started in this one kind of obscure corner of the US housing market. And within 2 years, Lehman Brothers was gone and the entire global financial system was on life support. This wasn't just numbers on a screen. This was a profoundly human crisis. Millions of people all over the world lost their homes, their jobs, their life savings.
So how on earth did we get to a point where the whole system was on the brink of collapse? Well, it started with a really lax attitude towards risk in general. But the real cancer at the heart of it was that the people originating the mortgages, they had no skin in the game. They made loans to basically anyone with a pulse because they knew they could just sell them off and collect a fee. And as supposed watchdogs, the credit rating agencies, they were in their own race to the bottom, slapping AAA ratings on garbage just to win business.
The entire global financial system became this incredibly fragile house of cards. And the foundation of this whole house, it was built on one single, flimsy belief that U.S. house prices would never fall on a nationwide basis. Of course, when that foundation crumbled, the whole structure just came crashing down in that exact spiral you see here. Defaults led to downgrades, which led to price collapses, which led to just sheer, unadulterated panic.
Okay, understanding the history is one thing, but being able to actually use that knowledge to make better investment decisions, well, that's where the real power is. So let's open up an investor's playbook for how to navigate these treacherous waters of the credit cycle.
I want you to think of this slide as your market weather vane. It's your cheat sheet. When you see that the dominant emotion out there is the fear of missing out, FOMO, that's a huge sign that it's time to be cautious. It means asset prices are high and future returns are probably going to be low. But when all the headlines are screaming about the fear of losing money, when capital is scarce and everybody is panicked, that's your signal. That is a sign that bargains are emerging because prices are low and potential returns are high. And I really want you to let this one sink in because it's arguably the most important lesson for any long-term investor. That slammed shut phase of the cycle, that moment of maximum fear, maximum pessimism, that moment probably does more to create incredible bargains than any other single factor out there. It's the moment that births the greatest investment opportunities of a generation.
It's so easy to get caught up in the hype of a great company or a hot new technology. We all do it.
But superior investing, it rarely comes from buying what's popular. It comes from having the discipline and, frankly, the courage to buy when the deal is good, precisely because everyone else is selling in a panic. That's when you find that magic combination, high potential return and truly limited risk.
So I'll leave you with this final thought. The credit cycle is this incredibly powerful recurring force, but it's not a mystery. It follows a predictable pattern, and it's driven by good old-fashioned human psychology. And if you understand its mechanics, you can not only protect yourself from its destructive power, but you can actually harness its creative potential. So as you look at the world today, ask yourself that one simple question. Is that credit window wide open, or is it starting to creak shut? The choice and the opportunity is yours.
All right, let's get into it. Today, we're not just going to talk about some dry financial concept. We're going to explore a story. You know, a story that plays out in the markets again and again and again. It's a story that's really about human nature, about how good times and that feeling of safety can, almost without us noticing, set the stage for a major crisis down the road. This is the story of the distressed debt cycle.
So what do we even mean by distressed debt? A lot of people hear that and think, oh, you're betting on companies that are just failing. But that's not it at all. The real heart of it, the mantra we live by, is right there. Good company, bad balance sheet. We're looking for businesses that are fundamentally solid. You know, they make a good product, they have real customers, but they've just been crushed under the weight of too much debt. The business model isn't the problem, their financial structure is. And that single distinction, it's the key to this entire world.
To really get our heads around this, we're going to walk through it like a 5-act play. First, we'll nail down that good company, bad balance sheet idea. Then, we'll look at how the fuel for a crisis gets piled up, a step we're going to call stacking the logs. After that, we'll see what happens when the igniter arrives and lights the match. That leads to the big climax, the market bonfire, when fear just completely takes over. And finally, we'll watch how, right out of the ashes, the cycle resumes. It's a powerful metaphor, so let's break down how this all works.
Okay, let's jump into part 1. To really understand the cycle, you first have to understand the goal of the investor, because it is a completely different way of thinking compared to your typical everyday bond investor. We're talking about a total shift in perspective. You're not trying to collect interest payments, you're trying to take control.
And here's where things get really interesting. See, a traditional investor buys a company's bond because they want a steady, predictable stream of income. They expect to get their interest payment, like clockwork, and their original investment back when the bond matures. Simple enough, right? Well, a distressed debt investor flips that logic completely on its head. They buy the debt fully expecting the company to default. They're not counting on those interest payments at all. Why? Because their goal isn't income, it's ownership. When that company finally goes into bankruptcy to restructure, the existing stockholders often get completely wiped out. And who steps in to become the new owners? The creditors, the people the company owes money to. So for them, the default isn't the disaster, it's the starting gun. It's where the real opportunity begins.
So the big question is, how do these opportunities even happen? I mean, they don't just pop up out of nowhere. The truth is, they're built. Slowly, quietly, piece by piece, usually during the best of economic times, when everybody is feeling great and confident. This is the second part of our story, and it's the first step in our bonfire metaphor, stacking the logs.
And this phrase right here, this is the whole ballgame. Every single one of these cycles starts in the exact same place. It starts when banks, lenders, and investors get a little too comfortable. After years of a strong economy and great returns, they start to forget what risk feels like. They start making loans to companies that are less creditworthy, or they agree to weaker terms. This unwise extension of credit is what creates the raw material, the fuel for the next crisis.
And this isn't random. It's a very predictable, very human psychological process. Just follow the steps here. It starts right after a crisis when everyone is scared. Investors are risk-averse, so they only lend to the best companies. Because the standards are so high, very few companies default, and the returns are solid. Well, those good returns start to create a feedback loop. People look at the recent past and think, hey, this high-yield stuff isn't so risky after all. That feeling of safety, that's complacency. And it attracts a flood of new money into the market. All of a sudden, there's a massive demand for these bonds, and Wall Street, well, they're happy to meet that demand. Standards start to slip, and money starts flowing to weaker companies on looser terms, all because the memory of the last painful downturn has faded away.
And this quote from Oaktree Capital just nails it. This whole cycle of forgetting risk and letting standards slide, that's what stacks the logs in the fireplace. The fuel is now in place. All those questionable loans and risky bonds that were issued during the good times are just sitting there, dry, brittle, and just waiting for a spark.
Which, of course, brings us to our third chapter. The setup is done,
the logs are piled high, and now the story takes a turn because the one thing that could set it all off is about to make its appearance.
This second ingredient is the igniter. Now, this isn't something that builds up slowly. This is a shock. It's a sudden event. It could be a recession that hits company profits or a credit crunch where the banks just turn off the lending spigot. Or it could be some major outside event, a war, a pandemic, you name it, something that just completely shatters confidence overnight. The igniter is the thing that finally puts all that weak debt that was created in the good times to the test.
And listen, this isn't just theory. The source material gives us a perfect real-world example from back in 1990. It wasn't just one single thing. It was a perfect storm of igniters. You had the Gulf War, which created all this geopolitical fear. You had a wave of bankruptcies from all those big debt-fueled buyouts from the 80s. And then the big one. The investment bank Drexel Burnham collapsed, which was the main engine of the junk bond market. That key player just vanished, and liquidity dried up overnight. These events completely and violently changed how everyone thought about risk.
So, the logs have been stacked. The igniter has struck the match. And now we get to the climax of the story, our fourth chapter, the market bonfire. This is that moment where the entire psychology of the market does a complete 180. Greed evaporates, and it's replaced by pure, contagious fear.
What happens next is a lightning-fast, self-feeding spiral. The economy slows down, and those companies with too much debt can't make their payments. The credit market slams shut. Suddenly, no one can refinance their debt, so defaults start to spike. This causes a massive psychological reversal. The very same investors who couldn't get enough risk a few months earlier now want absolutely nothing to do with it. Potential buyers just disappear. Nobody wants to be the one to catch a falling knife. So now you have only sellers. With everyone trying to get out the door at the same time and no buyers, prices just plummet. This triggers forced selling from funds that have to meet investor withdrawals, which pushes prices down even further. It is a terrifying, vicious cycle. But here's the absolute key to everything. That chaos is the opportunity. It is precisely during the heat of this bonfire, when people are dumping perfectly good assets at any price just to get out, that the disciplined, clear-headed investor can step in and find incredible bargains. The panic is what creates the potential for the kind of elevated returns that define this whole strategy. But, as we all know, a fire can't burn forever. Eventually it runs out of fuel and burns itself out. And that brings us to our final chapter. From the ashes of the bonfire, the conditions for the next cycle begin to form, logically and, really, inevitably.
And it all starts with that fear and caution. After getting burned, investors are shell-shocked. They're incredibly risk-averse. They will only lend money to the absolute safest, highest-quality companies.
The natural result? When you only lend to the strongest companies, you get very, very few defaults. The market becomes safe again. It becomes predictable.
But here's where that human psychology kicks right back in. A long stretch of safety and solid returns makes people forget what the pain felt like. They start to get complacent. They see years of good performance and start to think risk has just gone away for good. And they become risk-tolerant all over again.
And once that appetite for risk comes back, investors start hunting for higher returns again. The market is happy to oblige. You see more and more debt being issued, and eventually that includes debt from lower-quality companies. The chase for yield is back on.
You can probably see where this is going, right? This new batch of lower-quality debt is just the firewood for the next bonfire. It's vulnerable, and when the economy eventually hits another rough patch, these are the companies that can't weather the storm, and defaults begin to tick up once more.
And boom, the rising defaults send a chill through the market. Fear returns, panic sets in, and investors become intensely risk-averse all over again. We are right back where we started. The cycle is complete, perfectly set to begin all over again.
And that really brings our story to a close. We've seen how good times can breed a dangerous kind of complacency, how that complacency allows risk to pile up quietly in the system, how a single spark can set off a bonfire of fear, and then how the whole thing resets. The pattern is clear and it repeats because, well, human nature doesn't really change. Which leaves us with one final very important question to think about. As you look at the world today, where in this cycle do you think we are right now?
All right, let's talk about one of the most powerful and, frankly, most misunderstood forces in the entire world of finance, the real estate cycle. It's a market that's just surrounded by these comforting myths, but today we're going to cut right through all that noise to uncover the predictable patterns that really shape it. So, to really understand the cycle, you first have to dismantle the myths.
You know the ones. They're the comforting stories and these big, sweeping generalizations we all tell ourselves about property, especially when prices are flying high and it just feels like the good times are never, ever gonna end. Home prices always go up. Come on, we've all heard that, right? It's practically a mantra. But this one belief, this one little phrase, is the fuel for so much of the enthusiasm and, let's be honest, a lot of the recklessness that drives the whole market. But here's the cold, hard dose of reality. It doesn't matter how solid an asset seems. If you pay too much for it, no feel-good story in the world is going to save you from a bad return. The price you pay, well, that's everything. And these are the greatest hits of real estate myths. They're not making any more land. I mean, it sounds so logical, doesn't it? You can always live in it. It seems practical. But these simple little phrases, they make us ignore the single most important question an investor can possibly ask. Where are we in the cycle? So, how do we get past all these myths? We do it by looking at the data. And what's really interesting here is this one-of-a-kind study that tracked the price of a single house in Amsterdam, a house built way back in 1625, over centuries. This lets us see the actual, unvarnished, long-term performance without any of the usual noise. And the results are, well, they're stunning. The myth that property is some top-tier long-term investment just gets completely shattered. An annual return of just 0.2% after inflation, over 350 years? I mean, that's worse than the stingiest savings account you can imagine. It just goes to show that even prime real estate goes through these massive, multi-decade boom and bust cycles. Okay, so if it's not some kind of magical, ever-growing asset, what actually drives these huge swings? Well, like so many cycles in finance, it all kicks off with human psychology. This is what our source material calls the virtuous circle. It starts with some good news. Maybe the economy's doing well. This creates optimism, which encourages people to take more risks. They build more, they pay more for property, and all this activity pushes prices up even higher, which then validates that initial optimism, and the whole loop just feeds on itself until it feels absolutely unstoppable. And this quote just illustrates the problem so perfectly. During these booms, it's like we all get a case of collective amnesia. As John Kenneth Galbraith pointed out, we dismiss past busts as just ancient history, totally irrelevant to the incredible wonders of the present. We totally convince ourselves that, yeah, this time it's different. But the real estate cycle has this unique ingredient that makes these psychological swings even more dangerous. And that secret ingredient is time, specifically the massive, massive time lag between a decision to build something and the moment it's actually finished. I mean, think about it this way. In the credit market, a bank can dream up and create a new loan almost instantly. But in real estate, you can't just snap your fingers and conjure up a new skyscraper. The whole process, from planning to permits to actual construction, that can take years. And in those years, the entire economic world can flip upside down. Let's use a really simple but powerful example to see exactly how this works. Just imagine a town that clearly needs 100 new homes. The market's hot, and the opportunity is sitting there for everyone to see. Okay, so you have 10 different builders. They all see this exact same opportunity. And of course, none of them are coordinating with each other. Each one, acting totally rationally on their own, looks at the market and thinks, okay, I'll build 20 homes. I'll get a piece of that demand. And on its own, it seems like a perfectly sensible business decision. And right here, this is the punchline. Because all 10 of those builders made the exact same sensible decision completely independently, they collectively end up building 200 homes. They've just created double the supply for the actual demand, completely flooding the market and setting it up for a massive crash. And this isn't just some hypothetical. The source gives this really vivid real-world example from Los Angeles back in the 1980s. When the boom of the 70s turned into the bust of the 80s, the Wilshire corridor was literally littered with the steel skeletons of unfinished condo projects. These were the ghosts of decisions made in the good times that were finally being completed in the bad times. So this combination of human psychology and these super long development times, it creates this powerful and, frankly, predictable cycle. The key is just understanding its distinct phases. Let's just walk through it. It starts at the bottom, right? Times are bad. Nobody's building. Capital is super tight. Then, as the economy slowly recovers, demand starts to come back. With no new supply, prices rise. This sparks the boom. Optimism is back. Financing is easy. Developers rush in. Then we hit the peak. The first projects sell out like crazy, encouraging even more building. You see cranes filling the sky. But then comes the turn. The later projects get finished just as the economy starts to cool, and they flood the market. And finally, you get the bust. Vacancies shoot up, prices fall, building stops, which, and this is the crucial part, creates the very shortage that will start the whole cycle all over again. Now, let's actually see this in action, because understanding this cycle isn't just some academic exercise. It created one of the greatest investment opportunities of the last generation, right in the aftermath of the 2008 financial crisis. I mean, try to think back to 2009, 2010. The mood was just absolute despair. The consensus was that homeownership was dead, that demand for houses would be depressed forever. So in that environment of maximum pessimism, how could you possibly find a clear signal to make a huge, contrarian bet on housing? The answer was right here, in this single graph. And what's so fascinating here isn't just the bar on the far right showing low housing starts in 2010. I mean, sure, it's low, about the same as during wartime in 1945, but that's only half the story. The truly crucial data point, the one that tells the whole story, is that black line. Starts adjusted for population. And this showed that relative to the size of the U.S. population, new home construction had fallen to a level that was half of even the deeply depressed levels of 1940. Building hadn't just slowed down, it had basically stopped. And this right here, this is the power of cyclical thinking. While conventional wisdom was just projecting the crisis forward forever, the cyclical insight was the exact opposite. It showed that because the bust had completely halted new supply, any future recovery in demand would inevitably be met with a severe housing shortage, and that would cause prices to rocket upward. The correct move was clear. Invest when pessimism was at its absolute screaming peak. So, the key takeaway from all of this is that successful cyclical investing isn't really about predicting the future, it's about having a map to understand exactly where you are today. And to think clearly in cycles, the source material suggests we have to get rid of words of false certainty. You know, words like always and never. When you hear people say that home prices will never fall again, or that demand will be depressed forever, that should be a massive red flag. These are the words of emotional guesswork, not sober, cyclical analysis. And that leaves us with a final thought to take away. The goal isn't to guess the timing of the next peak or the next trough. The goal is to use this framework, the psychology, the time lags, the phases from boom to bust, to make an honest assessment of our current environment. So looking around at the cranes, the headlines, and the sentiment today, where do you think we are now? You know the feeling, right? The market is just on fire, all the headlines are glowing, and it really feels like the good times are here to stay. And then, poof, it seems like overnight the whole thing just comes apart at the seams. For so many people, that whiplash from total euphoria to sheer panic feels like it came out of nowhere, a complete shock to the system. And look, that surprise is totally understandable. I mean, when every single signal is flashing green, the economy's humming, company profits are through the roof, everybody's optimistic. It's almost impossible to even imagine the party ending. It just feels like, hey, this is the new normal. But what if it's not a surprise at all? What if it's not random? That's really the big idea we're going to dig into today. The market cycle, it turns out, isn't some chaotic force of nature. It's a deeply, deeply human pattern. It's a rhythm that echoes through history, all because the emotions that drive it, our collective fear and our greed, while they never really change. So to really get a handle on this rhythm, you first have to understand the two main forces that are always at play. Think of it like a constant tug of war for control of the market. On one side, you've got cold, hard logic. And on the other, you've got raw, powerful emotion. So on the one hand, you have the fundamentals. The investing legend Ben Graham called this the weighing machine. This is all the logical, measurable stuff you can put in a spreadsheet. A company's earnings, its cash flow, the overall health of the economy. Now, in a perfectly rational world, stock prices would just sort of calmly reflect all that data. But we don't live in a perfectly rational world, do we? We live in a world driven by what the economist John Maynard Keynes famously called animal spirits. And this is where things get interesting. It's the psychology of the crowd, all that optimism, that fear, that powerful, almost irresistible urge to just follow the herd that takes those cold, hard facts and stretches them into these wild, manic, and sometimes terrifying swings in price. Okay, so let's start our journey through the cycle with the fun part, the climb, the bull market. You got to understand, it doesn't just pop up out of nowhere. It actually evolves through some very distinct psychological phases.
It all begins really quietly. In stage one, this is usually right after a big crash, when the wreckage is still smoldering and pessimism is just everywhere. Only a very small handful of really perceptive, maybe even brave investors can look past all that rubble and see the potential for things to get better. Then we move into stage two. Now the recovery isn't a secret anymore. Good news starts to trickle out, and then it starts to flow. The majority of investors see the momentum, they feel more confident, and they start to buy in. And finally, we hit stage three. This is the real danger zone. The market's been going up for so long that people completely forget it can go down. The story in their heads changes from things are getting better to things will get better forever. It's that trees grow to the sky moment when all caution is just thrown to the wind. And this brings us to one of the most powerful sayings in all of investing. The wise investor, you see, acts in stage one. They're buying when assets are cheap, when they're hated, when nobody wants them. They're buying from pessimists who are just desperate to get out. The fool waits until stage three. They buy into the euphoria at the highest possible prices, and they're buying from those very same optimists who are now giddy with profits. Now think about that. The action is exactly the same. They are both buying. But their timing, driven by where they are in the psychological cycle, makes all the difference in the world. All right, so let's zoom in on that really treacherous moment right at the absolute top of the market. This is the point where psychology doesn't just nudge logic aside, it completely hijacks it. And this leads to some spectacular bubbles and a really painful experience that we call capitulation. So what is a bubble, really? It's more than just prices going up a lot. A real bubble has a very specific psychological fingerprint. It's the widespread belief that valuation just doesn't matter anymore. The story, whether it's the internet changes everything like in 1999 or housing prices never go down in 2006, the story becomes so powerful that people stop asking the most basic question of all. What is this thing actually worth? Instead, they start to believe that any price is a good price because, hey, there's always going to be someone else willing to pay more tomorrow. And if you think, oh, well, only idiots get caught up in bubbles, I want you to think again. This quote comes from one of the most brilliant minds in all of human history, Sir Isaac Newton. And he learned about the madness of the market the hard way, during one of the most famous bubbles of all time, the South Sea Bubble, way back in 1720. So here's the fascinating part of Newton's story. At first, he played it perfectly. He was a genius. He saw the wild speculation for exactly what it was, a total mania, and he acted logically. He sold his shares pretty early on and walked away with a huge profit. He did everything right. But then, human nature took over. He had to sit there on the sidelines and watch his friends, his colleagues, people he probably considered way less intelligent than himself, get fabulously, unbelievably rich. That fear of missing out, what we all now call FOMO, it just became unbearable. So he threw his own logic right out the window, gave in to the madness of the crowd, and jumped back in right near the very top. Of course, the bubble burst not long after, and he lost an absolute fortune. That feeling, that moment when the emotional pressure to join the herd is so intense that it forces even a genius to abandon his own judgment, that is capitulation. And as Newton himself could tell you, what goes up must eventually come down. So after that peak, the cycle swings the other way, and we enter the descent, the bear market. And just like the climb, it follows a surprisingly predictable psychological path. Does this look familiar? It should. It's the exact mirror image of the bull market. In stage one, while everyone else is still patting themselves on the back, a few thoughtful investors realize the party can't last forever and they quietly start to sell. Then comes stage two. The bad news is now impossible to ignore, and the majority of investors start selling, trying to hang on to whatever profits they have left. And finally, you get stage three, which is just outright panic. The story completely flips, and now everyone is convinced that the losses will go on forever. And of course, this is the exact moment that the fools from the last cycle, the ones who bought at the top, finally can't take the pain anymore, and they sell everything at the absolute bottom. Let's just break down how this becomes a self-reinforcing loop. So during the upswing, everything feeds on itself. Good economic news makes investors more optimistic. That optimism gets blasted out by positive media coverage. Greed starts to take over as the main emotion. Pretty soon, investors aren't worried about losing money at all. Their only fear is missing out on those easy gains. And this psychological tidal wave pushes asset prices way, way beyond any sane measure of what they're actually worth, which, of course, sets the stage for the fall. And then on the way down, that exact same machine just slams into reverse. It creates this vicious downward spiral. Bad economic news fuels pessimism. The media then amplifies every single negative headline. Fear completely takes over. Now, that fear of missing out is gone, replaced by the much more powerful fear of losing everything. Investors just sell. They sell anything and everything just to make the pain stop. And this pushes prices far below what they're intrinsically worth. And it's right here, in this moment of maximum pain and despair, that the seeds of the next big recovery are quietly being planted. So now that we've seen how this psychological pendulum swings from one extreme to the other, what's the single most important lesson to take away from all of this? It's simple, but it's everything. Where you are in the cycle is the single biggest factor that determines your future returns. Okay, let's start with the baseline. Let's say the market is right in the middle of its cycle. It's not too hot, not too cold. At this point, prices are generally pretty fair, and your range of possible future returns kind of looks like a normal bell curve. The outlook is, well, it's normal. But now, look what happens when we get to the peak of the cycle. This is the point of maximum good feeling, right? Everyone is euphoric. Everyone feels like a genius. But because the prices you're paying are so inflated, the entire range of likely outcomes has shifted against you. Your potential for future gains is now tiny, while your potential for a big loss is massive. And this, right here, is the great paradox of the market cycle. The moment things feel the absolute best for investors is the exact same moment their future prospects are actually the worst. And now, let's look at the flip side. At the very bottom of the cycle, when the headlines are terrifying, everyone you talk to is panicked, and it feels like the world is ending, prices are in the bargain bin. Now, the entire distribution of potential returns is skewed heavily in your favor. Your potential to lose more is pretty limited, but your potential for spectacular gains is at its absolute highest. This is the most important lesson of all. The time to invest aggressively is when doing so feels the absolute worst, because that's when your real outlook is the best. Which brings us right back to where we started. Look, understanding this cycle doesn't give you a crystal ball. You're not going to be able to predict the exact top or bottom, but what it does give you is a map that shows you that the greatest opportunities are always born from pessimism, and the greatest risks are always born from euphoria. And just knowing, even roughly, where you are on that map, well, that's the real key to navigating the madness of the crowd.
If you've spent any time at all in the world of investing, you know the feeling, right? That incredible high when the market is soaring, and then that absolute gut punch when it suddenly crashes. It is an emotional roller coaster, for sure. So the big question is, how do you actually navigate all that without losing your mind or, your money? Today, we're going to dive into a really powerful way of thinking that can help you not just survive, but maybe even thrive through the market's inevitable ups and downs.
So here's how we're going to tackle this. We're going to build this framework in 5 simple steps. First, we'll kick things off by busting a huge myth, what we're calling the forecasting fallacy. Then we'll learn a super practical skill, taking the market's temperature. After that, we'll get into the messy details with the anatomy of a bubble and the psychology of a crash, looking at some real-world examples. And then finally, we'll bring it all home with a strategy for balancing the twin risks that every single one of us faces as an investor.
All right, let's dive right in. Our whole journey starts with a simple but really profound truth, one that goes against pretty much everything you hear on financial news. And it's this: trying to predict what the economy or the market is going to do next is, well, for most of us, it's a fool's errand. The airwaves are just crammed with so-called experts telling you where the market's headed, but the source material we're digging into today makes it crystal clear. The actual track record of most forecasters is, well, let's just say it's not great.
And that right there leads us to the central question of this entire explainer. I mean, if we can't reliably see what's coming around the corner, how on earth are we supposed to position our money for it? It could really feel like we're just flying blind, completely at the mercy of the market's crazy whims. But here's the thing, there is a better way. The solution isn't to find a better crystal ball. It's to start asking a completely different question.
This quote is everything. It's the key that unlocks the whole puzzle. The core idea isn't to get better at predicting the future. It's to shift our focus entirely to the present. The goal isn't to guess what's next, but to get a really, really accurate read on what's happening right now. Because if you can understand where you are in the cycle today, that tells you a whole lot about what's likely to happen tomorrow.
But how do you do that? How do you get that good idea of where we are? Well, the source material suggests we need to learn a new skill, taking the market's temperature. And this isn't about vague gut feelings or hunches. No, this is a disciplined process. It's like being a doctor for the market, looking at the evidence right in front of you to diagnose the health and, just as importantly, the psychology of the current investment environment.
And this process really boils down to 2 key things. First, there's the quantitative part. We gauge the valuations. We look at the hard numbers, things like price-to-earnings ratios, and we see how they stack up against history. And second, there's the qualitative part.
We observe human behavior. What's the mood out there? Are people greedy? Are they fearful? You put those two lenses together, the numbers and the psychology, and you get a surprisingly clear picture of the present moment.
Now, check this out. This gives us a super practical checklist for taking that temperature. On the left side, you've got all the signs of a hot, maybe even overheated market. On the right, you've got a cold market, one that might be full of bargains. And the source offers some really great advice here. Just go through this list, and if most of your check marks end up in that left-hand column, it's probably time to hold on to your wallet. It's a simple but really powerful diagnostic tool. And we can even drill down a bit deeper by asking some really perceptive questions. Now, notice something here. None of these questions require a crystal ball. They are all about observing what is happening right now. Are people throwing money at every new investment idea that comes along? Is it easy to get a loan, or is it nearly impossible? These are the kinds of clues that tell you everything you need to know about the risks simmering just beneath the surface. And this is where this brilliant quote from Warren Buffett just hits the nail on the head. It perfectly captures that contrarian spirit you need. Basically, when you see everyone else acting reckless, when credit is loose and optimism is off the charts, that is not the time to join the party. That's your signal to double-check your own finances and be extra cautious. The behavior of the crowd is one of the most powerful signals you can get, if you know how to read it.
This idea really shows you the payoff of taking the market's temperature. So imagine that wavy line on the graph is the market cycle. Knowing exactly where you are on that curve doesn't tell you precisely what's going to happen tomorrow, but it does tell you the tendencies. It tells you the probabilities. When the market is way up high in its cycle, a downturn is just more likely. And when it's in the gutter, a rebound is more likely. It's not about being certain, it's about putting the odds in your favor.
Okay, enough theory, let's make this real. The absolute best way to learn how to spot these cyclical extremes is to look at them up close. So we're going to perform a couple of autopsies, dissecting two of the most infamous bubbles of our time, the dot-com bubble from the late 90s and the subprime mortgage bubble that, of course, led to the 2008 financial crisis.
Back in the dot-com boom, investor psychology went into a total frenzy. A key number we look at, the price-to-earnings ratio for the S&P 500, hit an all-time high of 33. Now, to put that into perspective, that was literally double the historical average since World War II. I mean, the numbers were basically screaming that things were completely unhinged from reality, but almost no one was listening.
And the behavior was just as extreme. Get this. There was a company called VA Linux. On its very first day as a public company, its market value exploded to $9.5 billion. Now, this was a company that had lost $14.5 million that same year. The source rightly calls this nutty behavior. And frankly, that's putting it mildly. It's a classic sign that rational thinking has just gone right out the window.
So why does this happen? This ancient quote from thousands of years ago just nails the psychology of a bubble. People who were getting rich off tech stocks wanted the party to keep going, so they just believed it would. They suspended their disbelief. They made up stories to rationalize insane valuations. It's a new era, they said. The old rules don't apply. This willing delusion is the rocket fuel for every single bubble in history.
Okay, now let's shift gears to the subprime crisis. This was a different kind of animal, but it was driven by an equally toxic dynamic. And the key concept you have to understand here is moral hazard. Just think about a system where you get paid huge bonuses for taking massive risks, but if those risks blow up, someone else has to pay for the cleanup. That's moral hazard, and it was woven into the very fabric of the mortgage industry.
And this is exactly how those messed up incentives broke the entire financial system. Lenders had zero reason to care if a borrower could actually repay their loan, because they just sold the loan off to someone else immediately. The ratings agencies, who were supposed to be the neutral referees, were instead competing for business by just handing out AAA ratings like candy. The whole thing was a house of cards built on the ridiculous assumption that housing prices would never, ever go down.
And of course, after the wild party of the bubble comes the brutal hangover of the bust. In 2008, that system, built on a foundation of bad incentives, finally came crashing down. And as it did, investor psychology did a complete 180-degree flip, from irrational greed to pure, panicked fear.
The damage was just breathtaking. I mean, look at those numbers. It wasn't just in one little corner of the market. The crisis spread everywhere. Stocks, loans, international markets, everything was down and down hard. These weren't just numbers on a screen. This was a vicious cycle of fear, where the only thought in anyone's mind was, get me out at any price.
But then, look at this.
Just 1 year later, the rebound was every bit as violent on the way up as the crash was on the way down. The very same assets that people were dumping in a panic in late 2008 produced absolutely spectacular returns in 2009 for anyone who had the courage to either hold on or, even better, buy when there was blood in the streets.
And this brings us to what might be the single most important lesson of all. The real damage from a crash isn't the temporary loss you see on your statement. That's just paper. The real permanent damage, the cardinal sin of investing, is panicking and selling at the bottom. That is how you turn a temporary fluctuation into a permanent loss of your hard-earned money. Understanding this is absolutely everything.
So, we've gone through the theory, we've dissected the history. Now, how do we actually put all of this into action to manage our own investments? It all comes down to a really simple but powerful way of thinking about risk, not as one single thing to avoid, but as a constant balancing act.
Every single day, every investor is stuck in this tug-of-war between two opposing forces, the risk of losing money and the risk of missing a great opportunity. They are a package deal. You can't get rid of one without being totally exposed to the other. The trick isn't to eliminate risk, but to intelligently manage the balance between these two.
And this is exactly how you do it. Your investment strategy shouldn't be set in stone. It has to be dynamic. When you take the market's temperature and it feels hot, investors are euphoric, prices are high, you shift toward playing defense. Your main worry becomes the risk of losing money. But when the market is cold, everyone is terrified, and good assets are cheap, that's when you shift to offense. Now your main worry is the risk of missing the opportunity of a lifetime. It's a constant adjustment.
And so that leaves us with this final critical question to ask yourself. Based on everything we've just talked about, the valuations, the investor behavior you see all around you, what's the market's temperature today? And what does that tell you about which of these twin risks deserves more of your attention right now? Answering that question for yourself is the first and most important step toward mastering the market cycle.
All right, let's dive right in. Today, we're tackling one of the most powerful and honestly one of the most overlooked skills in all of investing, understanding market cycles and actually using them to your advantage. This is about moving past just picking the right assets and getting into the art of when to be aggressive and when to pump the brakes. And let me be clear, this is not about predicting the future with some crystal ball. It's about preparation. It's about how to position yourself to shift the odds in your favor. You know, this is a fascinating statement, almost dangerously simple, right? The author came up with this line after watching a guy he knew who was, as he put it, congenitally optimistic and aggressive. This person was just always all in, pedal to the metal. And it just so happened that his timing was perfect. He was doing it during a massive bull market. So his success really seemed to boil down to this simple, potent formula. But you gotta ask yourself, can investing success really be that simple? So at first, the author's take on this was that the timing part of the equation was just pure dumb luck. I mean, what could possibly be better than being super aggressive at exactly the right, most fortunate time? It's a bit of a cynical take, but it seemed to work, suggesting that massive success was just about being in the right place at the right time with the guts to make a huge bet. But this was really just the starting point of a much, much deeper insight. The real breakthrough, like a lot of great ideas, it didn't happen in a flash. It came from a series of events that didn't seem connected at all. It started in Beijing. A client asked some really sharp, probing questions that get new ideas flowing. They get scribbled on a whiteboard, and he snaps a quick picture on his phone. Fast forward a few months, he's on a trip to India, just scrolling through his photos. And then, bam. He sees the picture of that whiteboard and it all clicks. The connection between those abstract notes and his old formula for success becomes crystal clear. And that, well, that was the epiphany. And here was the big aha moment. Timing doesn't have to be about luck. It can actually be a skill, a discipline. It's the skill of carefully, deliberately looking at where we are in a market cycle. You know, looking at the economy, at investor psychology, at valuations, and then positioning your portfolio based on that assessment. This insight completely flips the script on timing. It's not about buying a lottery ticket. It's a skill you can actually build. Okay, so if we can agree that skillful timing is possible, what does that actually look like when the rubber meets the road? Well, this whole epiphany led to a really powerful conclusion. Pretty much every active investment decision you make can be broken down into two main parts. Think of them like the two main levers you get to pull to shape your financial future. And here they are, super simple when you break it down. First, you've got asset selection. This is all about what you own. Which stocks, which bonds, which markets you think are going to do better than the rest. And second, you have cycle positioning. This is all about when you act, deciding the overall risk level for your entire portfolio. Seriously, every decision an active investor makes pretty much falls into one of these two buckets. So when we talk about cycle positioning, it really boils down to one big choice: aggressiveness versus defensiveness. Being aggressive means you're leaning into risk, maybe using leverage, buying stuff that's more sensitive to the economy. You're betting on things going well. And being defensive is the exact opposite. You're dialing back the risk, holding more cash, owning assets that can take a punch if things go south. This is the primary dial you as an investor are always tweaking. And of course, there are two other things in the mix here that determine how it all turns out. First, there's skill, or what the pros call alpha. It's simply your ability to make better decisions than the average person based on a solid, repeatable process. But we can never, ever ignore luck. Randomness is always there. It's the wild card that can make a great decision look stupid in the short term, or a bad one look brilliant. The goal, always, is for skill to win out over the long haul. All right, this is where it gets really fun. Let's make this visual because these concepts become incredibly clear when you can actually see them. We're going to look at how these big strategic decisions literally change the shape of your potential investment returns using the author's own graphics. Okay, so start with this mental picture. Think of the market's future returns as this bell curve. It's a probability distribution. Most of the time, the results are going to cluster right there in the middle, around the average. But there is always a chance of those really big gains or those really painful losses way out on the tails. This is our canvas. This is the raw material we have to work with as investors. Now watch what happens when you decide to get aggressive. You increase your portfolio's sensitivity to whatever the market does. See how that dotted line, your portfolio's curve, flattens out and gets wider? What that means is you've increased the probability of much higher returns if the market goes your way, but you've also increased the probability of much bigger losses if it doesn't. You are deliberately amplifying the market's moves. And here's the magic. When you get it right, if you correctly judge that we're in a rising market and you crank up the aggression, your portfolio shoots up even more than the market itself. You see that gap opening up between the two curves? That is pure outperformance, created because you combine the right read on the cycle with the right positioning. It's beautiful. Okay, now let's flip it and look at the other side of the coin. A defensive investor does the exact opposite. By cutting risk, holding safer stuff, they make their results less sensitive to the market's wild swings. This makes their probability curve taller and thinner. So you've lowered your chances of a big loss, which is great, but you've also accepted a lower ceiling on your potential gains. It's a trade-off. And this right here is such a critical point. This shows you how to win by not losing. If you correctly sense a downturn is coming and you get defensive, yeah, the market might fall, but your portfolio will fall by a lot less. See that gap? That is also outperformance. It's so important to remember that protecting your capital in the bad times is every bit as important as growing it in the good times. But here's the catch, and it is a big one. Timing is everything. If you get defensive, but the market surprises everyone and just rips higher, your cautious portfolio is going to get left in the dust. That shaded area on the chart, that's underperformance. That's all the money you left on the table. It's a powerful reminder that getting the cycle right is the key, because both aggression and defense have big risks if your timing is off. Okay, let's build on that because it's not just about timing, right? Beyond just deciding when to be aggressive or defensive, you've got that second lever, asset selection. And this gives you another, equally powerful way to tilt the odds in your favor. So the secret sauce to being a great asset selector is something the author calls second-level thinking. Look, it's not enough to think what everyone else thinks. The market price already reflects that. To beat the market, you have to find an insight that the consensus is missing. You have to think differently from the crowd, and this is the key part. You have to be right. So what happens when you get that second-level thinking right? You get this: asymmetry. I love this seesaw visual. It basically means you build a portfolio where your winners win bigger than your losers lose. You tilt the playing field so that the upside potential massively outweighs the downside risk. Let's put some pictures to this. On the left, you've got an investor with no special skill. They just match the market's return profile. Their curve is the market's curve. Simple enough. But look at the right. This is an investor with, well, negative skill. Their choices are just consistently bad, so their whole probability curve is shifted to the left. They actually do worse than the market, whether it goes up or down. Now look what happens when you combine an aggressive stance with real skill in selection. A skilled investor finds aggressive assets that have more upside than their risk would suggest. So when the market takes off, they take off even more. But when the market falls, they don't lose as much as you'd expect. See that? Their upside advantage is bigger than their downside disadvantage. That's asymmetry in action. And the exact same idea applies to a skilled defensive investor. Their talent is finding things that offer real protection when things get ugly, but still have some horsepower to participate when things are good. So they do much better than the market when it falls, but they don't give up all the gains when it rises. Again, they've used their skill to create a favorable asymmetrical outcome. And this right here, well, this is the holy grail. This is the investor who has it all figured out. They have the skill to know when to be aggressive or defensive, getting the cycle positioning right, and they have the skill to select individual assets that have these amazing asymmetrical payoffs. This is the best of all possible worlds, and it's what makes the truly great investors so great, and frankly, so rare.
I absolutely love this next quote. It's from the New York City detective who caught the Son of Sam killer. After it was all over, he said his job wasn't to be lucky, it was to prepare to be lucky. And that just perfectly captures the essence of skillful investing. You can't predict the future, you can't control luck, but you can study the patterns, you can analyze the tendencies, and you can position your portfolio so that the odds are stacked in your favor. You prepare so that you're ready when luck or opportunity finally shows up. So at the end of the day, what's the big takeaway from all this? It's that superior investing is not about being a fortune teller. It's about becoming a master of preparation and positioning. And that means the most important question you should be asking isn't what's the market going to do? It's, given the huge range of things that could happen, how is my portfolio positioned to handle them? Thanks for joining me for this explainer.
So let's talk about the holy grail of investing. The one question every single one of us has asked at some point. Can you actually time the market? You know, get in at the bottom, ride it all the way up, and get out right at the top. It sounds amazing, but as we're about to see, the real goal isn't about being a genius, it's about being a survivor. Okay, so here's how we're going to break this down. First, we'll look at why this idea is so tempting in the first place. Then, we'll dive into the big trap that catches almost everyone. After that, we'll explore a much smarter way to think about market cycles, what that looks like in the real world, and we'll finish up with the one mindset that matters more than anything else.
All right, first things first, we have to admit the whole idea of timing the market, well, it just makes sense on the surface, doesn't it? It feels like the most logical thing you could possibly do with your money.
I mean, of course, right? That's the whole point of investing. Buy low, sell high. That's what we're all trying to do. It's not just a reasonable goal, it feels like it should be the goal. Why wouldn't you want to use the market's ups and downs to boost your returns?
And this is where the dream meets reality. Because while the idea is simple, putting it into practice is a whole different ballgame. That very reasonable goal hides a world of pain and requires skills that, frankly, very few people have. The desire is easy, it's the execution that's going to get you.
So let's talk about that trap. How does this perfectly logical idea turn into something that can wreck a portfolio? This is the core dilemma, and trust me, it trips up even the smartest people in the room.
Okay, this right here is the absolute heart of the problem. You can do all the research. You can be 100% right that the market is way overvalued and that a correction is coming. That's knowing the probabilities. But that gives you absolutely zero information about when it's going to happen. And knowing what's probable versus knowing the timing, they are two completely different things. And here is a perfect and painful real-world example. Imagine it's 1996. You see the dot-com craziness and you say, nope, I'm out, this is insane, and you sell. Well, for the next 3 or 4 years, the market goes completely vertical. You look like an idiot. Your friends are getting rich, your clients are firing you, and you're questioning your own sanity. Then, bam, 2000 hits and the whole thing collapses. You were right. But you had to endure years of being wrong first, and that kind of pain can break anyone.
Let that one sink in. It's such a powerful idea. When you're early, no one gives you a medal. You don't get partial credit. For all intents and purposes, you are wrong. The market can stay crazy a lot longer than you can stay in business. And that time you spend waiting for the world to agree with you, it feels exactly the same as being wrong. So, if trying to pinpoint the exact top or bottom is a trap, What are we supposed to do? Just throw our hands up? No. There's a better way to think about this. A framework for navigating the market without trying to predict every single twist and turn.
But first, we need to get one key idea straight: intrinsic value. Just forget about the daily stock price for a minute. Think of intrinsic value as the real, fundamental worth of a company or a market. It's like its center of gravity. The price we see every day is just the emotional market dancing, sometimes jumping, sometimes crawling around that true value.
And here's the picture that makes it all clear. That straight line going up, that's intrinsic value, growing steadily over time. And that wild, curvy line, that's the market price, swinging way above the line in times of greed and plunging way below it in times of fear. Now the key is this: our job is not to predict the next little wiggle in that curvy line. Our job is just to have a rough idea of where we are today relative to that straight line. Are we way too high or way too low?
So what does this chart really teach us? Well, a few huge things. First, forget about trying to be clever when things are in that middle, fairly priced zone. It's too hard, and the payoff is too small. The real game is recognizing and acting at the extremes, when things are ridiculously expensive or dirt cheap. But here's the catch: those moments are incredibly rare, and you don't get to decide when they show up, the market does. So most of the time, the smartest thing to do is nothing at all.
Okay, that framework sounds great on a slide, doesn't it? Just wait for the extremes. Easy. But what does that actually mean in the real world? It means you have to have a level of patience that almost feels inhuman. This is not a game of action. It's a game of waiting. Let's put some real numbers on this. We're talking about one of the most successful investors out there. Over a nearly 50-year career, how many times do you think he saw one of those fat pitches? One of those extreme moments where he felt confident enough to really swing the bat and make a major call on the market cycle?
4 or 5. That's it. Over almost half a century. We're not talking about 4 or 5 times a year. We're talking about maybe once a decade. That just goes to show you how incredibly rare these true opportunities are. Your job is to be ready for them, not to force them.
And you can see them right here. These were the moments, the times when fear was so thick you could cut it with a knife, or when greed was completely off the charts. Those were the only times he felt the odds were so heavily in his favor that it was time to be decisive, to either buy with both hands or step way back from the party. Now this to me is maybe the most important quote of all. Even in those 4 or 5 perfect moments, the ones he waited a decade for, he still wasn't sure. He wasn't even 80% sure. He acted with trepidation. If one of the best in the world feels that uncertain at the moment of maximum opportunity, what does that say about the rest of us who think we can call the next turn with confidence? Which brings us to the big finish. If the opportunities are this rare and our confidence should always be in check, then what is the real point of all this? What should our ultimate goal actually be? This is where it all comes together. See, the goal can't be to have the best predictions or to hit the most home runs. Because as we've seen, those wins are temporary. Anyone can get lucky for a little while. So if that's not the goal, there has to be something deeper, something more permanent we should be aiming for.
And there it is. The trick is simply to survive, to make sure you're still at the table to play the next hand. You have to accept, deep in your bones, that being wrong isn't just a risk, it's a guarantee. It comes with the franchise. It's just part of the deal when you're dealing with an unknown future. Your main job is to structure your finances and your emotions so that you can take the hits and keep on going.
So that's the final question I want to leave you with. Forget about whether your strategy can make you rich if you're right. Ask yourself this: is your strategy built to let you survive when you're inevitably wrong? Can you handle the financial hit? Can you handle the emotional pain of looking like a fool for a few years? Is your portfolio, and more importantly, your mindset, built to last? Because that is the real secret to winning in the long run.
Welcome to The Explainer. Today, we're going to tackle a fascinating and, let's be honest, a totally counterintuitive idea: how winning can actually lead directly to losing. It's a concept that you see everywhere, in markets, in business, even in our own careers. So if you've ever found yourself wondering why the mighty fall, or how the underdog suddenly rises from the ashes, well, you're in the right place. Okay, let's dive into this. You know, this single idea is the key to understanding so much about, well, everything. It's not just some catchy phrase. It describes a real, observable pattern. It's like this invisible gravity that pulls giants down and helps the forgotten rise up. It tells us that nothing is permanent, that fortunes are always in motion, And it's a powerful cycle driven by one very, very predictable thing: human nature. I mean, it goes against everything we're taught, right? You work hard, you achieve success, and then you enjoy the rewards. Simple. So how can the very thing we're all striving for, success, be the very cause of its own undoing? It feels like a riddle, but it's not. There's a clear logic to it, and in this explainer, we're going to break down the mechanics of this perpetual seesaw. Okay, so the first thing you have to get your head around is that success is rarely a straight line that just goes up and up. It's a cycle, a rhythm of ups and downs. And the critical insight here is that each part of that cycle, the high points and the low points, they don't just happen randomly. In fact, each part actively creates the conditions for the next. Now that sounds super complex, I know, but the concept behind it is actually beautifully simple. Just think of a pendulum. The higher it swings in one direction, the more momentum it builds to swing back just as far in the other. Extreme success, in other words, creates its own internal weaknesses that pretty much guarantee an eventual swing back toward failure. So, where does this whole cycle kick off? Well, it starts inside our own heads. Long before success messes with a market or a company, it messes with the people running the show. And this, right here, is where the pendulum really starts its swing. It's a pretty blunt statement, but man, there's a lot of truth to it. Winning can make us think we're smarter than we actually are, that we've got some kind of magic touch. It can make us believe we figured the whole game out. And ironically, getting richer from that success can kill our motivation to keep grinding, to stay hungry, to keep learning. It's like a sedative that dulls the very senses that made us sharp in the first place. Now, what's really fascinating here is the incredibly fine line between the confidence you absolutely need to succeed and the hubris that success so often creates. See, confidence is what lets you take that bold, unconventional risk that nobody else sees. But hubris is when you stop questioning yourself, when you believe you just can't be wrong. One is essential for greatness. The other is a one-way ticket to ruin. This is one of the most important sayings in investing, and honestly, it applies to just about everything in life. When times are good and everything is going your way, it's so easy to feel like a genius. But that kind of success teaches two incredibly dangerous lessons. Number one, that making money is easy, and number two, that you don't need to worry about risk. Both of those are illusions, and they set a dangerous trap. And you can see the progression so clearly here. It's a predictable, almost tragic path. It all starts with a genuine win, but that victory slowly erodes the very qualities that made it possible. Humility gets replaced with arrogance, caution gets replaced with recklessness, and people start dropping the discipline and the margin of safety that protected them right when they need it the most. And this quote just nails the end point of that journey, doesn't it? That shift from healthy confidence to know-it-all hubris puts you in the exact same dangerous category as a complete novice. In markets and in business, thinking you know everything is often just as dangerous as knowing nothing at all. Okay, so we've seen how success can corrupt from the inside out, but it's not just about our own psychology. Success also creates these powerful external forces, especially when an idea or a strategy or an asset becomes incredibly popular. Think about it. Real bargains are found in things that are overlooked or misunderstood or just plain unpopular. They're cheap for a reason, right? But by the time the crowd falls in love with something, its merits are obvious to everybody. And that popularity drives up the price, it squeezes out all the value, and it turns what was a great opportunity into an expensive and really risky bet. You know, this process is almost like a law of nature in finance. When a strategy works really well, money just pours in. More and more people pile into the exact same trade, they're all competing for the same profits, until the opportunity is just gone. Its very success attracts the competition that kills future returns. This basically guarantees that no single strategy can work forever. And maybe the greatest example of this ever was back in 1979. After a just brutal decade for stocks, the consensus was clear: equities were dead. The entire financial media declared that stocks were finished, a relic of a bygone era. And they made that call right at the moment of maximum pessimism, which, as it turns out, was also the exact moment of maximum opportunity. A 28-fold return. Just let that sink in for a second. That's what was available to anyone who was willing to buy when everybody else was selling. The lesson is simple, but it is so hard to follow in the moment. Maximum unpopularity often signals a bottom. The crowd's despair created one of the single greatest buying opportunities in modern history. And when you look at their reasoning, you see they made a classic first-level thinking mistake. They saw what was happening, people were selling, stocks were unpopular, and they just assumed it would continue forever. They completely failed to ask the second-level question, because stocks are so unpopular, what does that mean for their price? And what does that cheap price imply about future returns? Now, this cycle doesn't just play out in abstract markets with squiggly lines on a chart, it also unfolds dramatically in the lives of individual companies. The forces of success and failure are just as powerful at the corporate level. Let's take a look at the classic case of Xerox. Back in the 60s, Xerox was so dominant, it seemed invincible. Their name literally became a verb for making a copy. But its enormous success, its sky-high profit margins, and its monopolistic behavior, well, it painted a giant target on its back. It invited government scrutiny and attracted hungry competitors. Success made them a target, and they were just too slow to realize it. The story of Xerox shows us exactly how success itself creates these vulnerabilities. A dominant company can get complacent, slow, and arrogant. It stops taking the big risks. It fails to protect its own turf. In essence, the winning formula becomes a straitjacket, blinding the company to new threats and making it ripe for disruption by hungrier, more agile competitors. But on the flip side, nearly dying was the best thing that could have happened to them. See, if success is a sedative, then failure is a powerful stimulant. That crisis forced Xerox to make the difficult, painful changes that were long overdue. It forced them to get lean, to refocus, and to regain their purpose. The failure laid the groundwork for its eventual survival and its return to profitability. So we've seen this cycle in our own psychology. We've seen it in markets, and we've seen it in companies. The question is, how do we use this knowledge? The key isn't to perfectly predict the future, but to understand the process. And that comes down to cultivating a much more sophisticated way of thinking about cause and effect. Okay, so this right here is the whole ballgame. First-level thinking is simplistic, it's linear. It just takes whatever is happening now and projects it into the future. But second-level thinking is completely different. It understands the cycle, it sees that today's good news and popularity can create tomorrow's risk, and that today's bad news and unpopularity can create tomorrow's opportunity. And look, this is not a new idea. This is a timeless pattern. This quote is from over 120 years ago, and it perfectly describes the exact cycles we've been talking about. Knowing this stuff isn't the hard part. The real challenge, back then and right now, is having the discipline and the courage to act on this knowledge, especially when everyone around you is doing the exact opposite. At the end of the day, navigating these cycles really means understanding that true opportunity is often most attractive when it's still undiscovered, unloved, and unpopular. The biggest returns aren't found by joining the cheering crowd after something's already a huge success. They're found by being there early, when things are quiet. So the question I want to leave you with is this. Are you positioning yourself as the wise person at the beginning of the story, or the fool at the end?
All right, let's talk about something that's absolutely vital to understand if you want to navigate the world of economics and investing. We're going to tackle one of the most persistent, most seductive, and frankly, most dangerous myths out there. The idea that this time, somehow, things are different.
You've heard this phrase, right? I know I have, more times than I can count. It's different this time. These four little words, they're like a siren song for investors. They sound so reassuring, so forward-thinking, like we finally outsmarted the past. But I'm telling you, from experience, they're almost always a warning sign that we're getting carried away and heading for a fall.
You know, at the end of the day, it all boils down to a simple, fundamental truth about us, about people. As long as human beings, with all our hopes, our fears, and our tendency to follow the crowd, are the ones making decisions, well, things are never, ever going to move in a neat, straight line. There will always be swings. There will always be booms and busts. It's not a flaw in the system. It's a feature of any system run by us.
Now, to really get why these cycles are a permanent part of our world, you don't need a fancy algorithm or a crystal ball. All you really need is a good history book. Because when you look back, it's kind of startling. You see the exact same story with the same confident claims playing out over and over and over again.
So let's jump in our time machine and go way back to the late 1920s. Can you just imagine the mood? It was absolutely electric. People felt like anything was possible. And by 1928, 1929, the so-called experts were all saying the same thing. America has reached a new, permanent golden age of prosperity. The party, they thought, would literally never end. Little did they know,
They were dancing on the edge of a cliff.
And look, this wasn't some fringe idea. This was the absolute mainstream consensus, coming from the very top. You've got the President of the United States, Herbert Hoover, saying things like this. The head of the New York Stock Exchange went on record saying there would be no interruption to the prosperity. And the thing is, they weren't trying to trick anyone. They genuinely believed it with every fiber of their being.
And what happened next? What was the result of all that unshakable confidence? It wasn't just a little dip or a minor correction. It was the Great Depression, the most catastrophic economic collapse in modern history. It plunged the world into a decade of pain. That proclamation of a golden age was the direct prelude to absolute devastation.
Okay, now let's hit the fast-forward button. We're jumping ahead 70 years to the late 1990s. The cars are different, the music is different, but listen to the language. It is almost identical. It's eerie. The internet was changing the world, and once again, the experts started talking about a new economy, one where the old rules just didn't apply anymore.
And this just shows you how deep this belief ran. I mean, this is from the Wall Street Journal, not some random chat room. And get this, at one point, a survey of top economists found that 51 out of 53 of them were predicting uninterrupted growth. The consensus was overwhelming. Recessions, they told us, were history. The business cycle had been tamed.
So, what happened after the cycle was tamed? Well, you know the story. The dot-com bubble imploded, kicking off a brutal, painful 3-year stock market crash. And really, you can draw a straight line from the excesses of that period to the even bigger disaster that was brewing just around the corner, the global financial crisis. Once again, the claim that cycles were dead was made at the absolute peak of insanity.
You'd think we would have learned our lesson by then, wouldn't you? But believe it or not, it happened again, just a few years later in the mid-2000s. And this time, they gave it a very official, very academic-sounding name, the Great Moderation. The theory was that, this time for real, smarter policies and fancy new financial products had finally created an era of unshakable stability.
And this quote from former Treasury Secretary Tim Geithner just captures the mood perfectly. The thinking went something like this. We've invented all these clever new financial tools, things like derivatives, that can slice up risk and spread it all around the globe so that no one part of the system can get hurt too badly. Devastating crises, they believed, were finally a thing of the past.
Now this one, many of us lived through this. I certainly did, and it's etched in my memory. That period of supposed calm, this Great Moderation, was the quiet before the storm. It was the direct prelude to the global financial crisis of 2007 and 2008. In fact, the very belief that they had eliminated risk is what created the risk. It encouraged everyone to take on more and more debt, more and more leverage, until the whole thing came crashing down.
So are you seeing the pattern here? It's as clear as day. Every single time we, as a society, get confident enough to declare that the cycles are over, that's not the signal of a new age of stability. No, it's a massive flashing red warning light. It's the dinner bell for a downturn. The moment everyone believes risk is gone is precisely the moment of maximum risk.
Okay, so the historical lesson is incredibly clear. The pattern is undeniable, which leads us to the biggest question of all. Why? If it's so obvious in hindsight, why do we keep falling into the same trap? Well, the answer isn't in an economic model or on a spreadsheet. It's in us. It's in our psychology.
This is really the key to the whole puzzle. If we can understand this, we can get to the very heart of how markets and economies actually work. And what we find is that they're a lot less rational, a lot more human than we like to think.
I absolutely love this quote from the great physicist Richard Feynman. It just hits the nail on the head so perfectly. Physics is hard, but it's predictable because electrons don't get euphoric, they don't get greedy or panicked. But economies are not made of electrons. They're made of millions of people, and people have feelings. And that one simple fact, it changes everything. What Feynman was talking about is what we call market psychology. You can think of it as the engine that drives the cycle. It's powered by these biases that are hardwired into all of us. Things like recency bias, which is just a fancy way of saying we tend to think whatever's happening right now is going to happen forever. And then there's the big one, herd mentality, that deep, primal instinct to do what everyone else is doing because it feels safer in a group. These forces, they're far more powerful than logic when it comes to creating these massive booms and busts.
So, let's break it down. How does this psychology actually work in the real world?
What's the mechanism that takes a perfectly good trend and inflates it into a dangerous, unsustainable bubble? Well, it's actually a pretty predictable chain reaction, and it's fueled every step of the way by emotion.
Here's how it usually goes. It starts with some good news, right? The economy picks up. That creates widespread optimism. We all start feeling better about the future, so we spend a little more and maybe save a little less. All that money sloshing around makes capital cheap and easy to borrow. So companies think, hey, let's expand. They build more factories than they need, hire more people than they can support long term, and all this frenzy of activity and collective good feeling pushes the price of assets, whether it's stocks or houses or anything else, up to levels that are just completely disconnected from reality.
And what you end up with is this wild emotional pendulum. On the upswing, it's all about greed and euphoria. The herd is running wild. People take any piece of good news and they project it out forever, convincing themselves that risk itself has been conquered. But when that pendulum swings back, it swings hard. The psychology flips completely to fear and despondency. People give up, they capitulate, selling everything at the worst possible time, totally convinced that things will never ever get better. We just lurch from one extreme to the other.
Okay, so what's the point of all this? You might be thinking it all sounds a bit depressing, but it's actually the opposite. Understanding that cycles are a permanent, unavoidable part of the landscape, that's not a reason to be scared. It's your single greatest advantage. It is a source of incredible opportunity, but only if you know how to see it.
The first step really is just learning to recognize the warning signs. When you start hearing people talk like this, when they say a trend will last forever, that the old rules don't matter anymore, that cycles are dead, that is when your internal alarm bells need to start ringing loud and clear. Just being able to spot these flawed arguments is your best line of defense.
And that really is the key. Trust me on this. The first time you go through one of these big cycles, it's easy to get swept up in the emotion of it all. But having been around the block a few times, I can tell you that by the second or third time you see it happen, you start to recognize the script. You realize, I've seen this movie before. It's never really different. And you can turn that knowledge into a massive advantage. You can be the one who stays skeptical when everyone else is euphoric. And maybe, just maybe, you can be the one who sees opportunity when everyone else is terrified.
And that's really the question I want to leave you with today. Because I promise you, this is not just a history lesson. This story will happen again. The technology will be different, the excuses will be different, but the underlying human psychology driving it all will be exactly the same. So the next time you hear those 4 most dangerous words in finance, this time is different, what will you remember? Because remembering these lessons of history, that's your single greatest tool for navigating the cycles of the future.
All right, so if you've spent any time at all in the markets, you know one thing for sure. They don't move in a straight line, right? They ebb and flow. Well, in this explainer, we're going to dive deep into that fundamental force, the market cycle. And look, understanding its rhythm isn't just some nice-to-have skill. I'd argue it's one of the most critical things any investor can develop. So, let's get right into it.
I love this quote. It's just the perfect way to frame how we should think about cycles. See, we're not looking for some crystal ball, some exact roadmap of what's coming next, the specifics, the companies, the new tech, the daily headlines. That stuff is always changing. But the patterns, the big picture movements driven by good old human nature, fear, and greed, that stuff stays remarkably consistent. It rhymes. And for an investor, that's where the real opportunity is.
Okay, so here's what we've got on tap. First, we're going to break down the basic rhythm of the market. Then we'll get into the really juicy stuff, the human psychology that's really pulling the strings. After that, we'll tackle the paradox of risk, build out a kind of playbook for thinking like a contrarian, and then we'll wrap it all up by talking about how to actually ride these waves.
All right, section 1, the rhythm of the market. Let's start with the absolute basics. What is a cycle, really? Because it's so much more than just a random series of ups and downs.
This is the key. The single most important idea to get right here is causation. The events in a cycle aren't just random things happening one after another. No way. A big boom isn't just followed by a bust. The crazy excesses of that boom are what directly cause the bust. And it works the other way too. The absolute despair and pain you see at the bottom of a bust, well, that's what creates the perfect conditions for the next boom to start. It's all one big, continuous chain reaction.
So, picture this. Imagine there's this central trend line, right? That's the midpoint, or the long-term average. It's kind of like what normal is supposed to look like. But the market, it's like a giant pendulum, always swinging way above that line and then way below it.
And while there's this natural pullback toward the middle, the powerful forces of momentum and human emotion are just so strong that the pendulum almost never gets to just sit still at that midpoint for any real length of time.
Yeah, so you've basically got these two massive forces in a constant tug of war. On one side, you have the movement to an extreme. This is what happens when momentum kicks in, optimism goes wild, and everyone gets that fear of missing out, FOMO. Then on the other side, you have the inevitable snapback, what they call regression to the mean. It's that pullback to reality. But here's the thing, the pendulum almost never just swings back and stops politely in the middle. Nope, the momentum is usually so strong that it blows right past the midpoint and careens all the way to the other extreme.
And here's the kicker, the consequence of all this. The further the swing goes in one direction, the more detached from reality it gets, the more violent the snapback is going to be. I mean, think about it. Small advances, they're followed by small corrections. A good solid bull market, eventually you get a bear market. But those huge euphoric booms and bubbles, they almost always end in a really painful bust or crash. It's like the higher you stretch the rubber band, the harder it's going to sting when it snaps back.
Okay, on to section 2, the human factor. So what's really driving these wild swings? What's the fuel for this engine? I'll tell you what it's not. It's not spreadsheets. It's not rational analysis of earnings reports. It's us. It's people. It's our collective, often irrational and always emotional behavior that keeps that pendulum swinging.
I absolutely love this comparison because it just hits the nail on the head. If you look at reality, the actual fundamentals of an economy or a business, it usually fluctuates in a pretty tight range. Things are either pretty good or, not so hot. But then you look at investor perception, oh man, perception doesn't do pretty good. It swings wildly from absolutely flawless, this thing can't lose, all the way to completely hopeless, it's going to zero. There's no in between.
So, how do you avoid getting swept up in all that? Well, this quote right here is the antidote. The superior investor, the one who succeeds long-term, is the one who can resist all that noise. They stay balanced, they act rationally, they see both the good and the bad, weigh it all objectively, and just analyze it dispassionately. It's about being an observer of the mania, not a participant.
And that, right there, is the whole engine of the market cycle in a nutshell. That psychological pendulum just careens from one extreme to the other. It swings from greed to fear, from euphoria to depression. And that quiet, rational, sensible midpoint, it's barely even a rest stop. It's just a place the pendulum swings through on its way to the next extreme. All right, section 3. Now this next idea, this is one of the most counterintuitive things in all of investing. But if you can get your head around it, it is incredibly powerful. It's the paradox of risk.
Just let that quote sink in for a second. The greatest source of investment risk is the belief that there is no risk. Think about that. The exact moment when everybody agrees something is a sure thing, that it's a can't-miss investment, that is the moment of maximum danger. Widespread comfort is the loudest alarm bell you'll ever hear.
And this slide lays it out perfectly. It's what I call the great risk inversion. In good times, when everything's booming, what does everyone think? There's no risk. Perceived risk is super low. Caution goes out the window. But because of that, the actual risk of losing money is sky high. Now flip that. In bad times, after a crash, what's the feeling? Fear, panic. Everyone thinks the risk is enormous. But because prices have already been crushed, the actual risk of loss from that point is often at its absolute lowest.
And that's exactly why good times can be so dangerous for an investor. When everyone is optimistic, caution just gets thrown out the window. People start paying ridiculously high prices for things, and they're willing to accept tiny returns for taking on huge amounts of risk. There's just no margin for error left. So when things finally do turn down, and they always do, those so-called safe investments get exposed for what they really are.
So what's the takeaway? The safest time to buy, the time with the greatest potential, it comes when everyone is absolutely convinced there's no hope. It's born from maximum pessimism. When the fear is so thick you can cut it with a knife, that's when prices get pushed down to bargain basement levels. And at that point, the actual risk is often tiny, and the upside, it can be absolutely massive.
Okay, section 4, the contrarian's playbook. We've talked about what the cycle is and why it happens. Now for the big question. How do we actually respond to it? What do we do with this knowledge?
This is a simple but really powerful way to think about it. The 3 stages of a bull market. Stage 1. This is when only a few really sharp people believe things might get better. It looks bleak to everyone else. Stage 2 is when most investors start to catch on. They can see the improvement is real. And stage 3, that's the party. That's when everyone concludes things are great and they'll get better forever. That, my friends, is the danger zone.
Now, here's a really important subcycle that pours gasoline on the fire, the credit cycle. Think of it like this. Prosperity leads to banks opening up the lending spigots. That leads to some unwise lending. All that unwise lending eventually leads to big losses. And when the losses pile up, what do the lenders do? They slam the brakes and stop lending. And when the lending stops, the prosperity ends, and the whole thing starts all over again. It's a classic.
And this quote from the great Sir John Templeton just sums up the whole playbook. To buy when others are despondently selling, and sell when others are greedily buying. It sounds so simple, right? But doing it, actually pulling the trigger when every fiber of your being is screaming to run with the herd, that requires incredible fortitude. But that's where the real money is made.
Ah yes, the 4 most dangerous words in all of investing. It's different this time. I mean, seriously, whenever you hear people using this phrase to explain why old rules don't apply anymore, why we're in a new paradigm, you should hear alarm bells going off in your head. It's almost always a sign that we're deep in stage 3, and people are just choosing to ignore history.
Okay, let's wrap this all up in our final section, riding the waves. How do we take all this theory and make it practical? How do we actually position ourselves for what's coming?
And this is maybe the most important takeaway of the entire discussion. Your goal isn't to predict the future. It's not about nailing the exact top or bottom. Nobody can do that consistently. The goal is simply to understand the present. As the great investor Howard Marks says, we may never know where we're going, but we'd better have a good idea where we are. It's about knowing where that pendulum is right now so you can decide, should I be playing more offense or more defense? That's the whole game.
So no, you can't predict, but you can absolutely prepare. And that preparation begins by using this framework to figure out where we stand today. Look around you, read the headlines, gauge the sentiment. Is there more greed or fear in the air? And then ask yourself that one essential question. Where are we now?